obviously we had a birth after COVID, but in the meantime, things have sort of gone back to normal. So resilience remains, in general, an area that sort of has managed to sort of get less investment compared to low carbon transition and innovation. Now, if I move on to ENDEs, so the results are not too different. Obviously, transport remains critical for most national governments, but obviously, when it comes to ENDEs, which includes BRICS country, water, social, and economic development are much more important compared to the high income, and the rest. There are obviously differences, but I think those are sort of the key one. Really, poverty elevation, sort of economic development remains key challenges. While I guess high income country sort of increasingly sort of focusing on sort of energy transition in particular. But again, here ENDs and BRICS are also focusing on energy transition. We just also have to achieve those social outcomes. So now, if we look at it for QEMDs, one thing that was actually striking is that when we look at sort of the average budget by compared to GDP, at least when it comes to central government, which obviously is very different. There's always very different rules between central government, local governments, SOEs, etc. But on average, when we look at high income versus ENDEs, there's actually as much effort on both sides. So in terms of average GDP per capita, there's not that much difference. And in fact, both have sort of increased slightly, as the previous graphs have basically shown. But I think while there was large increase in the total, which was mainly driven by income, here on the left side, you see the budget evolution for ENDEs countries within the G20. And here clearly you see stagnation. So a difficulty in sort of increasing that infrastructure investment from the public sector side, mainly again driven by sort of lower fiscal space and COVID. So that's been sort of pretty much flat in between, even though there's been some countries that are increasing, some of them are slightly decreasing, but on average, we're seeing a sort of no significant increase across the board. So that's for government today, so their budgets. We also compare that to actual investments, and I think in general, governments, I would say before last year, on average, infrastructure, there was a bit of an underspend, but in 2022, we saw the opposite, with the cost of material going up. Actually, most government sort of exceeded slightly the initial budgets. So again, those are budgets, but they're actually not that far from the actuals, based on the data that we've been able to review. So that's for today, I think the best. I think let's move now to what we call transition pathways, which is some work that we did last year under the Indonesian presidency for the G20. And the idea there was, again, this idea of like sharing innovation, new ideas, etc., and accelerating that knowledge sharing. So what we did was actually go through all the plans, infrastructure plans across the G20 countries and guests, so that's sort of 25 countries. And so we reviewed around 250 plans across those countries. Some of them were sectoral, some of them were more general. There's a lot of variety in those plans. So we're able to sort of collect the data to look ahead. What is it the governments are planning to invest in? And in many cases, in those plans, what is it that they expect the private sector to support as well? And so when we went through this, we were actually able, so there's obviously huge amounts, but actually when you compare it to the infrastructure investment gap, those numbers are actually not that big. I mean, we're talking about 12 trillion between 2020 and 2030, and obviously that's actually not. I mean, that's actually not enough when it comes to the investment gap. But a couple of trends that sort of came out of that. Digitalization of services was again one of the key one, increasing renewable as well. Low emission vehicles. So I would say that across the board there was relative clarity. Was mostly on renewables, on the two other one. But as you can see on the left-hand side, when it came to sort of climate resilience, restoring ecosystem, we actually saw a lot less plan that actually had clarity on that. So I think Besides the numbers, the quality elements and the achieving the transition elements was in many plans still missing. And what we do hope is that through that work, governments and countries will be able to learn from each other, because they are overall, for each issue, there's usually a plan out there that's actually pretty elaborated and had some estimates as to how much it could cost, and also how it could be financed. So those are sort of transition pathways that we sort of collected through the review of those 200 plans plus. Obviously, we had to sort of summarize quite a few, and that's actually an ongoing work that we're testing with a few countries. We're sort of doing currently some work in the Pacific for some islands, where we were able to sort of use that data to compare to their current plan in order to put them sort of get more comfortable around how comprehensive that plan is, and whether it's sort of to be able to benchmark themselves and also learn from all those countries that have more capacity, and also we're able to develop full-fledged plans. So again, anyone interested in that work and sort of interested in sort of supporting that work going forward, we very much welcome any sort of comments or a partnership. When we look at those transition pathways, I'm not going to go into too much detail here, because there's obviously a lot to unpack. But I think, again, what we found, maybe a little bit surprising, is that many of those plans were actually looking at universal access through digitalization, a lot of innovation and technology that were there, besides the renewable energy, which again was the most developed transition pathways across the board by far and large. What we saw as well, again, is that when it comes to resilience and adaptation, that's the opposite. There's actually very few plans that have addressed that, and that includes the restoring land and water ecosystems. So I think that's still pretty much an emerging field for most countries. When it comes just a side note on technology, what we found is there's actually a lot of appetite and a lot of potential for those technologies to really achieve better outcomes. So what we did last year, we collaborated with 8 MDBs, so the 8 largest MDBs, and we actually sort of worked with them to reach out to the private sector and sort of find out solutions for one of the key investments, which remains road. And so we look at solutions for road to become more sustainable and more resilient. And I think while the university have massive capacity, it was interesting to see that there's still a gap in sort of knowledge sharing and sort of mapping of solutions. And we really do hope that through that work, that would potentially be deployed across 100 projects. We'll also be able to deploy it even beyond the NDBs, and that will be able to scale up those solutions, because many of them really can achieve more for the same investment. It adds up a little bit more effort, I guess, on the project preparation side, but the outcome and sometimes the efficiency, the cost efficiency included, can be actually very remarkable. So we do hope, and again, that's what comes out of the plans as well, that technology innovation applied to infrastructure will sort of be scaled up across borders. That's an example of the matrix that we're able to come up with each of those problems and the type of activities we're able to identify technological solution. And again, this hasn't been done. It's a public good to a certain extent. So we're happy for anyone sort of interested in that. We're doing a lot of work with the NDBs. We're actually exploring ways to scale that up in Africa in partnership with the NDB as well. So we really do hope that we'll be able to scale that up, because that again has a huge potential when it comes to addressing the infrastructure gaps that we talk about. So that was mostly public sector, and obviously when it comes to technology, a bit of private sector. But I thought I'll take a bit of time as well just to share some private sector trends. Private sector comes in different ways. There's obviously investment through projects for which we have relatively good data, and there's a lot of investment through corporates, and that is a little bit harder to get. But I'm going to share some of the brand new trends. So actually the graph that you see on the left, something that hasn't been published yet. It will be published towards the end of the year in our annual infrastructure monitor report. And so this year we partner with different data providers to be able to get access to even more transactions. So our partners include so the BPI database and their providers, Bloomberg as well, to be able to gather even more data when it comes to those transactions. And that would be the base of that updated monitor report. And so what you can see here is, on the left side is that sort of new graph for 2022. And the trends are, they're not exactly great. Let's be honest. From the EMD side, we see a lot of potential for the private sector at the sort of the mirror, the high income, especially when it comes to renewables, but also telecommunication, etc. We actually have seen since 2019 an increase investment towards those countries. Unfortunately, while we did see an increase in EMDBs overall, we haven't seen the same at the same size. Well, I think we all hope that we can sort of scale that up, and we believe there are ways to scale that up and make the EMDs sort of trends catch up and eventually exceed the high income one, given the size of the infrastructure gap. So there's couple of reasons for that. Obviously, enabling environments, also cost inflation in the meantime. But I think there's a couple of trends that we can look at, and that can be interesting. So what we saw in terms of financing ways is the increased use of green bonds. There are obviously some BRICS markets that have extremely developed, particularly China and green bond markets. But I think when it comes to infrastructure, private project, we clearly see that in high-income countries that's sort of increasingly being used, both mostly at the corporate level, but also a sort of project finance level. And that's definitely something that investors are comfortable with globally. And I think as a result of developing those sustainable finance markets locally as much as possible is critical nowadays in order to attract private investors. A couple of macro trends that are unfortunately impacting investment at the moment. So we've seen the latest trend in terms of actual proven transactions. But I think something that we've seen is, unsurprisingly, is the construction costs have sort of increased drastically. Usually construction costs have been relatively in line with inflation. What we have seen here on the left-hand side, and we'll update that graph towards the end of the year, is that the construction costs have actually exceeded, for the first time in sort of 10 years, the pace of inflation itself. And so the cost of material and obviously the cost of infrastructure building have increased quite significantly, which means that, again, for the same amount in real terms, you're still getting less on infrastructure. And so obviously that sort of put more pressure on the public sector side, but also on the private sector. On the right-hand side, what you can see as well as the cost of capital. The cost of capital, mainly driven by interest rates, has actually increased also significantly, which means that for any investor globally, the expected returns obviously have sort of gone higher. So the threshold for investment is a little bit harder to get to. But we can see that sort of tap it off a little bit, and I think we all hope that the latest data will actually show us a return sort of more manageable, I guess, with the average cost of capital. So now, in terms of what's the impact on the appetite? So we've seen again the trends in actual transactions. What is the appetite for infrastructure? Obviously, costs, interest rates are sort of dented a little bit against that appetite, and unfortunately, we've seen that at least in the initial part of the year. So when you look at the dry powder, so the amount of capital that is ready to be invested in infrastructure funds. We had a very clean growth over time, a bit of a slowdown with COVID. And 2022 was actually a record year. But most of those funds are actually still in North America and Europe, increasingly in Asia, but that remains still very much, all that dry powder is still concentrated in high-income countries. And maybe more worryingly as well, which we've seen across markets, is that the beginning of 2023 has been really, really tough for investors. It's been very difficult to sort of respond. I mean, there's two reasons for that. I mean, the one that I mentioned, also the fact that 2022 was a record year, especially in the beginning of 2022. You can see on the graph on the right hand side that was very high. So there's still a lot of dry powder at the moment, but it's true that for many funds across the globe, fundraising for infrastructure has sort of slowed down quite a bit, and so that sort of made investor a bit more, I wouldn't say reluctant, but I think it is definitely a pace change when it comes to appetite to invest in infrastructure. So I think so that's kind of like, I guess, the global trends. Now, what is it that we can do to basically change or sort of leverage some of those trends? Last year, we actually worked at the G20 with all the MDBs, all the governments, and also many sort of private sector players to identify the key levers. That's the document that was endorsed by finance ministers. It's basically a framework that look at the key actions that can be deployed. So I'm not going to go into the details of each of them, but that document is available online. It gives everyone, I guess, a framework as to what are the key levers that you can get, and obviously each levers then need to be adapted to the local environment, to the local gaps. But I think I just wanted to go back to two things that we see having a key impact on investment in sustainable infrastructure. The first one is definition, data, standards, disclosure, and the fourth one is financial innovation. So when it comes to standards, taxonomy, reporting, we definitely see that as increasingly featuring in infrastructure markets across the board, and I would say even beyond the existing regulations. Obviously, the G20 has worked on QI principles, and we continue to work. So this year, we're under India presidency. We continue to add a few projects where we're testing out the QI principles. There are higher standards for firms like the ISHB standards that were also endorsed by G20. But what we see is the emergence of standards dedicated to infrastructure and sustainable infrastructure. They're not widespread at the moment, but I think it's important to understand that this is not necessarily something that's driven by a regulator. It's actually something that investors are asking. They want to make sure that their projects are sustainable to them, but also will be considered sustainable in the future, because no one wants to end up with assets that in 10 years' time won't be attractive to the market. And so I think there's a real demand from the market for the standards. I'm not sure where it's going to end up. What is for sure is that demand is not sort of decreasing, it's actually sort of increasing, and actually the standards the requirements are actually sort of being developed further, including nature, ecosystem, etc. So I think again, there will be different regulations across different markets, but I think it's important to understand that markets actually are actively sort of pursuing their understanding of the quality or the sustainability of the infrastructure investments. And that we expect that trend to continue going forward. The other part that we actually working on this year as a global infrastructure hub with partners is innovation when it comes to infrastructure finance. So we've looked at sustainable finance markets, green bonds, etc. But I think there's a clear request, and actually when we did the framework last year, setting up de-risking instruments was a key priority that was identified across the board by government, MDBs, and private sector. And I think here we're actually looking for partners countries to sort of test out how we could assess the gap in the market and what type of instruments could be scaled up. There's a couple of challenges here. One is data scarcity. It's actually quite difficult to get to know which instrument was used when. Those instruments are very complex. There's a whole sort of sets of different ways. And as you can see on the right-hand side, the data that we have for partners at Convergence sort of shows that on average, it's actually usually a combination of different things that sort of make projects viable in the emerging market. And that mix can include guarantees, concessional finance, commercial loan by MDBs, potentially as subordinated debts, and then that's how you basically attract sort of private sector. So the data on the right is still very preliminary at this stage, but I think what's important here is that from what we sometimes hear, that there's like the magical solution that will sort of unlock tons of capital. I think the reality is that's a bit more complex than that, and again, I think we want to test that out in a few countries to be able to work in partnership with sort of leading private sector investors that are ready to jump in, test out how we could sort of identify those instruments and be able to work with the G20 and so the FIs in scaling out those instruments, because we really think that's critical in unlocking private capital in the emerging market. And finally, one of the aspects we're looking at as well is regulatory barriers at this sort of global level, whether it's banking or sort of insurance frameworks. That's something that we'll sort of continue to work on. So I think I'll stop there. But again, very keen for anyone to that's sort of interested either in a tracker, the transition pathway data sets, or countries that might be sort of keen to test out how we could come up with a framework to assess and then identify de-risking instruments that could unlock private capital. Please reach out. And any other question, please feel welcome as well. Thank you.
Thank you very much, Henry. That was a very insightful and detailed presentation that gives us a sense of trends both in the government sector, public sector, and also the private sector. And I think later on we'll get an opportunity to ask questions and test some of the numbers that you have put across. But thank you very much for that presentation. At this point, I will then invite Dr. Mamiko Yokoi Arai. She is the Deputy Head of the Investment Division in OECD, and she will also still on trends and setting the scene. She will give us some of the pension-related statistics and research also into their regulation and how they contribute towards infrastructure financing and development overall. Dr. Mamiko, the stage is yours. Over to you. Thank you very much.
Thank you very much. And thank you very much for the invitation to take part today. I just want to preface the presentation by saying that I've tried to highlight the latest data, which means that while we collect some of the data that is relevant to BRICS country, it's not always covered. So just bear in mind that it's based on the latest available data, but it doesn't necessarily mean that I've tried to include the BRICS country, but it's not always going to be present. So thanks. So today I just want to talk a little bit about some of the investments related to pension funds in particular, because I understand that some of the pension funds are taking part in the session as well. But maybe more to give you a global perspective on where we are and what sort of considerations can be born from that. So the pension fund asset size is considerable globally, even in emerging developing markets as well. So we've looked at 68 reporting jurisdictions at the end of 2021. 2022 data is now being processed at the moment. So this is the latest that we have. It's 38.5 trillion. And most of these are in the OECD area, that's 37.7, but the 10 trillion at least is in non-OECD areas as well. So this in itself is a huge pot of money, and this is why a lot of the infrastructure investment discussion and policy area does tend to focus on what can we do to get this institutional investors, in particular pension funds, to also invest into infrastructure as well. I'll talk in a later part of my presentation a little bit what are the barriers to this, specifically try to be as specific as possible, but just say that there is a lot of money that is floating around, but how this is actually allocated is sort of the key question that I sort of want to try to address in the presentation. So this is looking at the total funds of pension funds, both in OECD countries as well as non-OECD. As you can see, it doesn't mean that OECD countries actually do have large pension funds. If we compare some of the lower countries like Luxembourg, Estonia, theirs is actually much smaller than countries like Brazil and China and even Namibia or Morocco. So therefore, the potential of using or leveraging at least some of your local pension funds is actually a really practical and realistic way that you might want to go about thinking about this as well. Obviously, the US has a humongous pot of pension funds, but that doesn't mean that they're necessarily available. And I'll talk a little bit about why that might be the case. So just to say that the level of pension fund assets is not going to be very, very different between the non-OECD and the OECDs, although I guess some of the top 10 OECD countries do have a considerable size. So now I want to look at some of the average asset allocations that pension funds make. And so this is not based on, so the previous slide that I showed you is based on reporting from pension supervisors themselves. So it is on a national level, whereas this data is based on pension fund level data collection that we've done. Because unless you look at the pension fund specific, you cannot actually get down to the very granular allocations that are being made. So one of the sort of takeaways, this is from 22 data that we are processing at the moment from the large pension funds, is that there's been a real increase in cash and deposit, and this puzzled us a little bit, and we tried to look at some of the regulatory changes that might have informed this. But I think our takeaway based on some of the qualitative comments that we received is that the huge sort of increase in the cash and deposit is a result of adjustments to the higher interest rate environments that are happening. Probably also to some of the financial market sort of dynamics that are happening as well. But it has been notable that the asset allocation to cash and deposit has been quite considerable. I think the other thing to take a closer look is actually at the changes in the unlisted infrastructure investment. This is the main way in which pension funds allocate their assets to infrastructure investment, to use unlisted infrastructure investment. But this can also pose a number of problems because they are not publicly listed. Means that some countries have regulations that actually prohibit the pension funds from doing. But just to say that this is the main vehicle in which infrastructure investments are being made, and there has been a considerable increase over the past year. So this is not necessarily around infrastructure investment per se, but I wanted to take a look at the destination of foreign investment. And this is from 2021 data, going back like 6 years. So we can see that Asia emerging is one of the most main destinations which pension funds make their cross-border investment. This is followed by Latin America, and then Africa and Middle East, I think, are on par in terms of the level of investment that they receive. This is relevant because if we are thinking about emerging and developing countries that want to receive more investment into their infrastructure, the destination in which pension funds are willing to make their foreign investment is very relevant because there are considerable risks that are involved in foreign investment, notably foreign exchange risk, which is a large inhibitor to institutional investors. This may not necessarily be an inhibitor to corporations that take part in a PPP and develop infrastructure project themselves in the local market, because they will have cash inflow that is in the local currency. But if they are an investor that is sort of operating out of their local market and they don't have a local cash flow, then the foreign exchange risk will be quite real, and they'll probably hesitate to make the investment. So now let's look a little bit more granularly at the foreign investments that are being made. And this is the direction in which the regions that the investments are being made. So you'll see that there are some considerable investments that are being made into Africa and Latin America. But overall, Asian emerging is the destination that most pension funds are able to make their investments. It's quite interesting to look at the direction of the investments that are going. So, for example, I think the top fund is a South African. So it's obvious that they make investments into Africa, and therefore a considerable amount of their foreign investment is made into Africa. However, on the other hand, a considerable amount of their investments are also made into Europe emerging. Let's look at the other funds. Maybe just let's maybe look at the other South African fund, which I think is maybe the sixth from the top, all their foreign investment is directed towards Africa. This is quite indicative because I think at the end of the day, the pension funds are obviously much more home biased to their local markets. So when they make their investment decisions, they will have a clear preference of making their investment into a local or a regional markets where they have much better understanding, because accumulating the knowledge and know-how about the sort of market conditions in a foreign market is much more prohibitive to any pension fund. And also this depends on the size of the market of the fund as well, because if the size of the fund is bigger, they will have more resources at their disposal to be able to make analysis or develop local market know-how to be able to make these investments. And I think this is the case for some of the Canadian pension funds in particular. So now I want to look more specifically into the investments that are being made into the infrastructure sector specifically. This is from our 2021 data collection. I think this reflects very well with Henry's presentation, in that renewable energy and energy are overall the most popular investment prospects in terms of the sector in the infrastructure sector. I think it's clear some of the breakdown of energy may in fact be renewable, because it wasn't necessarily always clear exactly where the case is, but it's clear that energy and renewable in total are extremely popular. And I think when we talk to investors ourselves, because we have a number of projects that we make, we actually talk directly to investors to try to figure out what are the barriers to their investment. The thing they mention the most, I think, in terms of the sector they like to invest in, is renewable energy and data centers. This is their favorite because of a number of issues. I think for renewable energy, I think it's very clear that they can gain the credits required for sustainable financing. And also it is a growing sector, so the prospects are very good. And I think there's questions about how to connect the grid to the renewable energy projects, but nevertheless, it is a clear way in which they can expose themselves to sustainable finance. Otherwise, IT and data and communications, this is also popular because of the lack of public sector involvement in some senses. Data centers is a very clear, I think, go-to area. You want a considerable amount of land, you can build your sectors, it can be remote, and there's a lot of, I think, upside for investors. So these are the two areas that I would say that we hear from investors as being very popular, and one areas that they think is less, that has a clear cash flow for them. Now, let me now turn to some of the issues for considerations when pension funds invest into infrastructure. So the darker box is sort of going over some of the more negative sides, I would say. So for example, they are concerned about the specific risk profile that an infrastructure investment might bring forward. In part of that, this is also related to the complexity that I list at the bottom of infrastructure, because there is just a longer time frame and you get locked into your investment as a result in some cases. Also, the considerable costs that I already mentioned. The few examples that I've seen of pension funds investing very proactively into infrastructure investment have been when they set up their own asset management company. This is the case for some of the Canadian funds, as I mentioned. They've established specific resources to actually be able to make, and also local offices to be able to make investments into the infrastructure projects, in particular into some of the larger emerging markets. And also this requires a very specific skill set to be able to analyze the infrastructure projects. I think it's clear when we are trying to find specialists that are aware of how the infrastructure projects are developed, as well as how the financing works. It is very, very difficult to find a knowledgeable person. So therefore, the skill set that a pension fund might require is very challenging. Now, this was also, I think, mentioned by Henry as well, but the data around infrastructure investment is very, very sparse. We have looked at all the private vendors that are providing some relevant data around this. And I think the conclusion that we have reached is that most markets are not covered. The European markets and the North American markets are very well covered, but the regional markets, the African market, the Latin American market, the data is almost non-existent, I would say. Middle East as well, very, very lacking. And then Asia, some of the key markets are covered, but beyond that, they're not very much covered. So therefore, even if investors purchase private vendor data, they won't get sufficient data that will give them knowledge and coverage around these markets, which makes it very, very difficult for them to make a good understanding around these markets and how the projects might perform. The other issue is that they don't have enough scale to be able to make the investments. Because if you're only, I think the average infrastructure investment of the pension funds from analysis that they make from their asset allocation, the average was about 0.8% of their overall portfolio, which means that it's a very minor, asset allocation that they're making overall. And putting resources into this can be very difficult if you're a small pension fund, first of all, and if your exposure is very small. If you're making a considerable exposure to the infrastructure investment, I think it could be worthwhile, but these are big challenges because a lot of the pension fund sizes could be very, very limited. The next area is obviously government policy. If the governments are not putting forward consideration and policies that are encouraging more infrastructure investment, then the pension funds will be very reluctant due to the prudential considerations that they have. Now, the benefits obviously for the pension fund is their diversification. They can get more diversification. There's more cash yields that can be expected from the infrastructure, and there's lower volatility. But this doesn't necessarily lead to greater investment from the pension funds. So maybe it's worthwhile to take a look at a little bit more of the granular data. So we've done a lot of, we do annual collection of investment regulations related to pension funds. And we know that the general investment limits are around asset class, concentration ratios, or credit rating. This is the way that the pension supervisors do the supervision and the regulation. So in terms of the countries that permit direct and indirect investment into infrastructure, it's quite wide ranging, going from Australia to Zimbabwe. So a lot of countries across the spectrum do allow direct and indirect investment. So the countries that only allow indirect investment, so through financial vehicles, are also quite numerous, including some of the larger markets as well. Now, in terms of the explicit infrastructure-specific investment limits, there are also a number of countries that have these as well. But there's also a number of other countries, and in particular in the European Union, that have that don't have specific investment regulations, because they have what is called a prudent person rule, which is also already explained in the Australian case. But this is also across all of European Union as well, in that they don't have specific investment regulations, but they depend on the pension fund to apply the prudent person principle to be able to make the decisions themselves based on the risk portfolio that they want to expose themselves. So these are the countries that have indicated that as long as the prudent person principle is applied to your investment allocation, then you can do whatever you want. But obviously that doesn't mean that they're necessarily going to make infrastructure investments because of the previous considerations that I presented. So asset class regulations exist. I think the most common is around the limit, the caps on debt securities that can be invested into debt. And then there is also asset class regulations related to the equity of concessionaires. So otherwise, other instruments in which investment into infrastructure is permitted is investment funds. These are the next most popular vehicles that are permitted. These could be real estate, private equity, infrastructure funds, or ETFs. Also, just private equity is another way in which some countries permit you to make infrastructure investment. And then there's other instruments such as SPVs. And it's probably worthwhile to just consider SPVs in particular, because they are what you would call a small and medium-sized enterprise. And it goes back to what Henry mentioned in terms of the reporting requirements. As you mentioned, ISSB is now in the process of developing reporting requirements for listed companies. This means that most infrastructure SPVs will be excluded because they are very small. So the question that we have been discussing is that what are the trickle down that the ISSB reporting requirements will have for these smaller funds? Because it is very, very prohibitive to comply with the ISSB reporting requirements. And this is why, for example, some of the European companies are actually trying to have the ISSB reporting requirement expanded to the SMEs, because for banks in particular, it's very prohibitive because they would actually have to go down to the borrowers and try to understand what the borrowers are doing. And so if the SMEs are already reporting, it will mean that the bank's cost will be less. So the ISSB is becoming a big issue for sustainability reporting in particular. And I think it is to be seen how this will really sort of expand the scope of reporting related to sustainability going forward. So then there are the foreign investment limits, and there are a number of foreign investment limits that are already that are applicable and also will impact how the infrastructure investments can be made. So I just wanted to go over a couple of the recent regulatory changes for investment that can affect some of the infrastructure related things. And these were all made, which is very noticeable during 2020 in the height of the COVID crisis. Because one of the, I think, takeaways, especially in terms of pension fund regulation, was that because the overall investment sort of was depressed, there was a strong impetus from the governments to actually try to encourage pension funds to make more investments into infrastructure, which will have a long-term economic recovery implication. So based on this, Chile and Switzerland made specific changes, which were quite interesting for our discussion. For example, the cap on alternative investments was raised, and alternative investment is relevant here because that is the main way in which pension funds in Chile can make their infrastructure investments. I don't know if you're familiar with the Chilean pension system, but they are very much a sort of saving sort of vehicle way in which they permit it. And they have, I think, 5 funds from the least conservative to the most conservative. And basically, depending on your age, the fund you invest in will be different. So let's look at the least conservative. So they permitted the alternative investment to be raised from 10% to 13%. So that this is the biggest allowance that is made for pension funds to be able to invest into alternative investment. So at the same time, the most conservative fund, the cap was maintained at 5%. So these are fairly limited, but depending on the size of the fund, the actual nominal rate, the absolute rate of change could be quite large. So these were the changes that were introduced in Chile in 2020. For Switzerland, they actually changed the investment category that infrastructure was included in, because previously infrastructure was part of the investment classification in terms of asset allocation, including hedge funds, private equity, and insurance-linked securities, as well as commodities. So they separated out infrastructure and instead allowed infrastructure to be its individual investment allocation and gave it a 10% limit. So that could be a considerable change, because previously, together with these different alternative investments, basically, it was a 15% cap, and that cap, which was then separated out to make a 10% limit specific to infrastructure investment. So that is the end of my presentation. If you have any questions, I'll be happy to respond at the end. Thank you very much.
Thank you very much, Dr. Mamiko Yokoi. All right, that was a very comprehensive presentation on some of the trends of pension funds in infrastructure investment. And I'm sure that we will have very interesting discussions later on, just to unpack some of the aspects that you raised in your presentation. At this point, I will then move to the panel discussion. So I will introduce the panelists. We have, including our lead speakers, we've got about 4 of them, 5, 6 of them. So it's quite a lot of them on the list coming from different areas, and they'll be able to, number one, share their own insights and their own perspectives, and also be able to contribute to the how do we increase the scale of and pace of infrastructure investment, given the opportunities and the risks and some of the ecosystem trends that we have just been presented with. So we have Mr. And maybe before I introduce the panel, please remember that we do have the Q&A section. If you can start formulating your questions. We did agree at the beginning of the session that we are going to have a very active session and active participation. So I don't want to be pointing and going into participants and asking participants to have questions ready. So at this point, if you can start putting them on the chat, that would be helpful. But also you will have an opportunity to raise those questions at the Q&A time later on. So start preparing those questions, because we said we are going to have a conversation. We should not be talked at, but we should have a conversation that at the end of the day, we are able to achieve the objective of this symposium. Minister has given us marching orders earlier in terms of setting the tone and the expectation that he has of convening all of us in this forum. So it is important that we are participating, and we are actively thinking about some of these issues that are coming. If we have insight that we can share, we also prepare those insights. It doesn't have to be a question. It can be a contribution into the investment, infrastructure investment discourse. That would be the key essence of this symposium that has been organized. So we have Mr. Busisa Gia, and he is the CEO of Association for Savings and Investment South Africa, and we usually just call it ASISA. And we have Mr. Tabiso Mushikara. He is the fund principal of unlisted investment at the Public Investment Corporation. It usually goes by PIC. And we have Dr. Shao Xiang Chen, and he is the director and the senior researcher at Chinese Academy of Financial Services in China. And we have Mr. Alexander Kulakov, and he is the head of infrastructure bonds at Credit Analytics, Russia. We have Mr. Ankit Jain, who is the senior vice president of SBI Capital Markets, India. And we have Mr. Prasad Gadkari, who is the executive director and chief strategy officer at the National Investment and Infrastructure Fund in India. So you can tell that we've got such a diverse panel that is going to share insights from various vantage points. So we're very excited, to be able to delve a little bit deeper into some of these issues. So I will start in that order, and I will ask that you share a little bit about what you do as a panelist, and also your contribution and reaction to the session 1 topic, which is looking at unpacking infrastructure development landscape, and as part of setting the scene, as part of setting the tone for the discussions later and also the discussions tomorrow. Mr. Busisa, I will hand over to you. You've got 5 minutes, but we've been able to save a bit of time as we are moving along. So if there are pertinent areas that you feel strongly about, please feel free. If you are taking too long, I'll just switch on my camera to say that it is time for you to wrap up. So over to you, sir.
Thank you very much, ma'am. My name is Busisa Jia. I'm the CEO of the Association for Savings and Investments South Africa. We are a non-profit organization that comprises memberships across 125 members that are insurers, asset managers, investment administrators, collective investment schemes, and management companies. Collectively, the membership manage approximately 6 trillion rand, and amongst our members are those that invest on their own balance sheet, and those would typically be life insurers, and the asset managers would invest on behalf of their clients. And so with that 6 trillion, there is a clear need in identifying infrastructure as almost its own asset class, albeit that it will be across different sectors, hence our interest. Our members, clients in the form of asset managers have patient capital in the sense that they are also comprising of retirement funds, which we heard a speaker talk about. And in the case of insurers, they insure and therefore have long-term outlooks. And for me, the risks and challenges across infrastructure is that you need patient capital. For the longest time, markets have tended to depend on publicly listed companies, and that remains where one can find infrastructure. However, increasingly we find that you need to source infrastructure opportunities, and those tend to be in the private markets. Complexity of infrastructure by nature of being long-term is that it involves a number of parties. You need the asset owners, typically represented by retirement funds or life insurers on board. You need development finance, you need the banks, and we all need to work together, firstly to identify the investment opportunity, but ultimately to bring it to market. And that could be in the private markets where it's unlisted, or in the public listed space. But ultimately both require the same thing, in the sense that an investment prospectus needs to be produced. Common phrase amongst the publicly listed space is an IPO. When you have an IPO, the whole world can participate. And I think for me, there is a clear goal that we all gather around the table and work together, even if it is by starting with an example, so that can set precedents where we bring to market infrastructure opportunities. That is really, for me, fundamentally the summary of the challenge faced by this industry. There is patient capital. However, we need to work to bring to market these investment opportunities. And by that, I mean offer retail investors, institutional investors, retirement funds, members of CISA in terms of life insurers and asset managers, the opportunity to invest across what I describe as needs. For our definition, infrastructure is across water, the water and sanitation, in the sense that water is scarce, whereas 70% of the world's mass is water. However, water that we can drink and use is scarce. In terms of transport and logistics, free mobility is important, and that is across South Africa and the continent at large. Africa is by all accounts one of the biggest continents. And if it is to prosper in future, it has to have the roads, the rails, the ports that allow for easy and simple access, mobility, and freedom of movement that is critical for any development and any contributors to economic growth. And in addition to that, one has to consider other infrastructure sectors such as food, in agriculture, as commonly phrased, in the ability to produce food for a continent and a wider world where food production in terms of arable land favors Africa, and there's an interest for that. Energy, forms of energy in electricity generated by different means, in a world where we accept that there are limited resources that may have unintended consequences in terms of environmental, in terms of the environment and the ability for us to sustain life. So across energy, there are different forms in terms of hydro and water, in terms of wind, solar, and one has to take advantages of where the location is of that infrastructure development. It's important that as all the participants play their role in the value chain of infrastructure, we acknowledge that it is to elevate life in terms of bringing capability where it wasn't. By example, I'd phrase free mobility as key, the ability to move from one end of Africa to the other end using different forms of transport. That speaks to the individual and also to the business that trades across the continent and across the world, and hence it's quite important that we develop infrastructure. There's a consideration that in the years of COVID, we have also placed emphasis in terms of healthcare and the importance of that being easily accessible to all across South Africa and the world. And so that is included as one of the sectors in terms of infrastructure. What's left for us to do now is to agree who are the participants that sit around the table that are part of the value chain that will source these infrastructure investment opportunities and bring to market in such a manner as all who wish to participate can, and that is across retail investors, that is across institutional retirement funds, governments, and corporates who have an interest in growing and strengthening economies that will allow for trade and a better life for all. Those are my remarks, and I think that as we face a more difficult and unpredictable world, I think it's compelling us to gather around the table as we are for this symposium to find solutions on how we can invest for the future. And for me, that is what infrastructure is, investing for the future. I thank you very much.
Thank you very much, Mr. Busisa Jia. Investing in infrastructure for the future. I think we heard that. And we are going to unpack and also get some of your reactions based on what you're seeing, some of the sectors that you believe connectivity are important, water, relative to some of the emerging sectors that Dr. Mamiko has presented, where you can see there is some misalignment in terms of where asset managers are focusing, where there's a hype around renewable energy, and not much around some of the aspects that you've highlighted. And maybe when we get a second opportunity around, you can come through and reflect on some of the differences and how do we overcome them? Because as you say, we are looking for solutions, we are looking for ways to ensure that infrastructure development happens very speedily and in a manner that is able to address some of the challenges that have been raised. So thank you very much for that. I'll move on to our next panelist, Mr. Thabiso Mushikara, who is a fund principal in unlisted investments at Public Investment Corporation, to also share his perspectives and give us some sense of what is he seeing from that area. if you recall earlier, unlisted is one area where investment in infrastructure happens. And as Dr. Mamiko reflected that, there is a challenge because it's not publicly listed, and to the extent that others can participate in the space and the regulation, etc., does play an impact. So it would be great to hear from your perspective, given that you've got very intimate knowledge around unlisted investments and how you think about infrastructure. That would be greatly appreciated. So at this point, I'll hand over to you to just give your perspective. Also, just share a little bit in terms of what you do as you reflect on some of the issues that have been raised as well. Thank you very much.
Yeah, thank you. Thank you, Tepi. So yeah, I'll just touch on, what, I have been seeing from my side from the unlisted investment perspective. Let me just, start with what I do. So I'm the fund principal for unlisted investments within the PIC's unlisted investments, formerly known as the ECBIA Fund. So as you know, the PIC manages funds on behalf of mainly public sector institutions. And we have three largest clients, the first being the Government Employees Pension Fund, which has about 2 trillion of assets under management. And the balance, comes from the UIF, the Unemployment Insurance Fund, and the Compensation Fund. In total, the assets under management are about, I think, north of 2.3 trillion rands. So the unlisted investment looks after mainly infrastructure. So we look after economic infrastructure, energy, and the social infrastructure. So I look after the two, the economic infrastructure and the energy infrastructure. So within the economic infrastructure, we have transport and logistics, we have water, we have telecommunications, and in the energy side, we look after a number of energy technologies, from conventional power to the renewable energy. And in terms of the instruments that we look at, we participate across. We take a vertical slice in terms of our participation. We've got the ability to do equity. We can do something in between a hybrid instrument, and we can also look at advancing debt. But all this has to be unlisted. So that's essentially what we do on our side. But just to touch on what we're seeing, and I think what we see in our space mimics, or I think talks to what Mamiko was talking about. And in terms of the themes that we see in the infrastructure space, we have seen increased investment in mainly the sustainable and green infrastructure. So we've seen large investments coming through into the renewable energy space since the government has initiated the renewable energy IPP program in 2011. Throughout the rounds of the program, from round 1 to about, I think, round 5, we have seen significant investments coming into that space. And if I can touch on some of the numbers that we have seen. So between round 1 and round 5, I think, the country managed to procure about 7,000 megawatts of power, and that came from about 97 IPPs. And we as the PIC, we've managed to take about 15% of that slice. And in terms of the total project cost that were that the government has managed to to raise, was about 229 billion of infrastructure costs, of transaction that have closed, and about 57.1 billion of that were mobilized, by the Public Investment Corporation. So we have seen significant investments coming through there, and about 19% of those funds came from FDIs. So, and I think this is a clear indication of, what a clear regulatory, environment can do in terms of generating investments and creating infrastructure investment and bringing together the private and the public sector in the infrastructure space. And I think, I'm probably, touching on, what is happening and also what needs to happen from the government side, in terms of bringing in the private sector participation into the infrastructure space. And I think, in South Africa, we do have the blueprint model that we can use. And I think the RIPP program, is one such model that we can tap into. And I think this can be replicated across, especially in the water infrastructure space. We have seen a significant underinvestment in the water infrastructure space. We have seen, the master plan that was produced by the Department of Water and Sanitation that talks to the increased investment that is required in that space. And I think what the report says is that the government requires about almost R1 trillion over the next 10 years, to invest in water in order to alleviate the water challenges that might come. And I think the report talks to that the government could, face water challenges. The country rather could face, water challenges starting from 2030. And if you can think about it, 2030 is not far out. We're in 2023 to 2024, in 6 years' time. The country could face, significant water challenges if investments do not come through in that space. We've also seen, and then this talks to what Mamiko said as well, the increased investment in the digital infrastructure space. If you think about the transactions that have happened recently, even though some of them we have not participated in, we have seen international companies coming in to buy digital infrastructure assets in the country. I think one notable one is the transaction that happened between Digital Realty, a New York-based data center operator, buying a South African data center operator, to the tune of about $3.5 billion. And I think, that demonstrate, the increased, interest, in the digital infrastructure space. We have also seen a number of transactions in the country as well. Some might not have been finalized as yet. The Vodacom transaction with CIVH and Remgro. So we have seen. We have seen, the activity, including the M&A, activity. We've seen a number of private equity funds, investing significant amount of capital in the space as well. And that I think, is a demonstration of where there's clear, regulatory, certainty. There is, or there will be rather, improved participation from the private sector. And I think we've also seen, so we do have a funds of funds division within the PIC. We have allocated funds to a number of infrastructure, private equity funds as well. But when you look at the pipeline that they have, in most instances, the pipeline that they have consists of infrastructure assets that have already been created. They've reached commercial operation date, and they just require refinancing, or there's assets that moves from one fund manager to another, which I think does not assist in terms of what the the requirement for infrastructure investments are in the country. So we have allocated about 5.5 billion rands to such funds. And if you look at, and I'll pick just one, so we have allocated funds to AIM, AIM Infrastructure Fund, that looks at mainly infrastructure investments in the continent and sub-Saharan Africa. And if you look at the investment that they've already made, and I think there's about 12 of them, only one is in South Africa, and it's in the digital infrastructure space. And I think that demonstrates that South Africa needs to look at how they can attract investments in the country. So I think in essence that we have seen, and I think just to give an example of what a clear regulatory environment can do for a country. I mean, if you look at the renewable energy, and I'll go back to the renewable energy again, when the renewable energy IPP program started in 2011, there was increased activity in that space, and I think in around 3.5, around 4, there was some sort of regulatory hurdles that the program had to go through. I think this information was publicized widely, where ESCOM wanted to renegotiate some of the IPP contracts, and I think that created some sort of regulatory uncertainty, and we have seen interest in that space from especially the international investors waning. So and I guess this can demonstrate, in my view, the importance of clear regulation, and also what regulatory uncertainty can do in terms of chasing investors survey. I think I'll stop there, Thabiso, and thank you.
Thank you very much, Thabiso. That was really comprehensive. And I think one thing that came through over and over again is a very clear regulatory dispensation that is able to crowd in private sector participation. So that is very clear. And also scaling that, you've mentioned some of the examples in the energy sector that can be scaled to water and other areas of infrastructure, and to scale it up in that way. So thank you very much for your insight and that contribution. I will quickly then move over to Mr. Xiaoqiang Chen, who is the Director and Senior Researcher at the Chinese Academy of Financial Sciences. Mr. Chen, over to you. Thabiso, thank you very much. You can switch off your camera, and then we'll hand over to Mr. Chen. Over to you, sir.
Yes, thank you. It's my great honor to make a brief introduction of China's infrastructure investment, particularly on the risk and opportunities. The first issue is the trend and the current situation. Between between year 2003 and 2017, China's overall infrastructure investment grew at a compound annual rate of 17.3%. And this growth rate slows down from year 2018 to year 2021 to only 2.2%. And last year, the growth rate increased to 11.5%. And in the first half of this year, investment infrastructure rose 7.2% year on year. As of the regional components, by year 2020, the proportion of infrastructure investment in the East, Middle, West, and Northeast of China is 33.5%, 24.7%, and 34%, and 3.8% respectively. And the new development trend is that China made a huge achievement in terms of infrastructure. For example, with the rapid development of new energy vehicles, China has built up the largest number, service range, and a variety of charging infrastructure in the world. Another example is that China makes solid progress in building computing infrastructure. Since 2018, the annual compound growth rate of the number of the data center racks exceeds 30%. By the end of last year, more than 6.5 million standard airframes were in use. According to the China Information and Communication Research Institute, the scale of core computing industry reached 1.8 trillion RMB last year. The overall competitiveness of China's infrastructure has improved significantly. According to the World Economic Forum's of Global Competitiveness Report 2019, China's overall infrastructure competitiveness ranks 36 out of 141 economies, surpassing developed countries in some areas. The reason behind the quick development of infrastructure part of due to the policy-based financial support. For example, in June last year, China State Council executive meeting identified policy-based development financial instruments to support major infrastructure projects. The two patches of policy-based and development-oriented financial instrument totaling more than 700 billion yuan has been put into operation, supporting more than 2,700 projects. For example, the China Development Bank, CDB, further extended the maximum duration of loans for infrastructure projects in various fields, including major projects such as water conservation, railway, urban rail transit, and airports to 45 years, the maximum. By the end of December last year, CDB had 76% of the long-term loans over 15 years in the infrastructure sector. Of course, China has to face the barriers and the risks in these areas. The first is the impact of COVID-19. Everybody knows that. And the second is the involvement of private sector infrastructure. The participation rates for private sector in the long term slows down. I mean, over the more than 30 years. And the third issue is the fiscal sustainability. The China's fiscal deficit is around 3%, 3% in the past years. So it's a little bit high due to the quick development of infrastructure, particularly in the local levels, government levels. Despite this, we are still optimistic about the future, about the future of the scale and the pace of infrastructure investment. After all, China is the world's largest potential consumer market with a complete industrial system, rich human resources, convenient software and hardware infrastructure conditions. Now China is deeply reform and opening up in an all-round way, implementing the strategy of innovation-driven development and laying a solid foundation for safe development. So we are going to do the following issues. The first is to coordinate security and development, and development investment on infrastructure with high qualities. We need not only the quantity, but also the quality of the infrastructure. For example, we are going to accelerate the 14th five-year plan involved in the 102 major projects and other major economic and social development projects, continuing implementation of transportation infrastructure, support the development of urban villages in large cities and megacities, upgrade infrastructure such as bridges, gas pipeline, water supply, and drainage pipeline and heat pipeline, after all, so as to promote the construction of safety projects for the lifeline of urban infrastructure. Promote emergency dual-use public infrastructure construction. Develop new type of infrastructure, for example, strengthening the top-level design, promoting computing architecture, computing methods, and algorithm innovation, and enhancing hardware, basic software, application software, and other adaptations to industry, transportation, medical, and other typical industries as the main scenario to create a number of major solutions. The second issue is to promote private investment on the infrastructure development. Currently, China approved setting up a new organization, namely the new Private Sector Development, Economic Development Administration, which is under the National Development and Reform Commission, NDRC. Its main functions are as follows: understanding, analyzing, and judging the development of the private sector, coordination and organization the formulation of policies and measures to promote the development of the private sector, to formulate policies for the promotion of private investment, establish a regular communication and exchange mechanism with private enterprise, coordinate the solution of major issues concerning the development of the private economy, and coordinate support for the private economy to enhance its international competitiveness. To more detailed, there are following measures to be done. Optimize financial support for private investment projects. The first batch of 315 non-government investment projects has been sent to the China Development Bank, China Industry and Commercial Bank of China, CICBC, and Citibank, for example, and recommend projects to private capital. The list of major projects, industrial projects, and franchise projects were compiled and submitted by the governments. As of September 2023, more than 3,500 projects with a detail of 2023 of over 3.7 trillion has been reported. Unblock the channel of non-governmental investment, relying on the online investment project approval and supervision platform. The establishment of non-governmental investment issues reflect column and develop non-government investment issues collection and management methods. Promote private investment infrastructure. Real estate investment trust, we call it REITs. Such projects cover clean energy, big data centers, consumer infrastructure, warehouse and logistics, industrial parkings, and other sectors. Guide the scientific decision-making of non-government investment. Organize project training on improving the quality of private investment projects. Guide private enterprise to pay more attention to feasibility study to make investment decision more scientific and accurate, and to decrease the risks of private investment on public infrastructure. That's all. Thank you very much.
Thank you very much, Mr. Chen. Very much appreciated. I think China's rapid infrastructure investment is there for everybody to witness. And sounds like there was just a deliberate intentional channeling of funds into infrastructure investments. So while we talk about private sector participation and crowding in private sector participation, I think at times we forget that the public investment does provide an anchor and does provide an enabling an environment to start crowding in private sector participation. And one of the themes that are coming from what you're saying also is, you know, while we are looking at scale of infrastructure rollout, the quality of the infrastructure that we are talking about is equally important. But also another takeaway is that with the policy-based financial support that was quite intentional, the government budget deficit increased. And I suppose it is productive and you're able to justify why that has increased. And so it is important to be able to link the funds and also the infrastructure development that is being done. So we do note, and I'm sure there are learnings that we can have, and you'll get an opportunity to give us, one or two, if we have to take one or two aspects from the China experience, what are those to be able to increase the scale, the quality, and the pace of infrastructure investments across. And in the earlier presentation, I mean, I don't know how much you're seeing those private sector funds, because some of the pension funds that are destined towards Asia, I don't know whether it's China or it's just broader Asia, maybe when you come back again, just to reflect on what you're seeing in terms of those trends in China, that will be greatly appreciated. We move on now, ladies and gentlemen, to Mr. Alexander Kulakov. He's the head of the infrastructure bonds at Credit Analytics, Russia, to also weigh into the subject matter. If he can tell us what he does, and also then reflect on the topic and some of the developments that they are seeing out of Russia, and pick out, highlight areas where we can also learn and improve in our various areas. Mr. Kulakov, if you can come through, I'm not sure if he's on. Mr. Kulakov, Utumelo? Do we know if Alexandra is with us? Okay, I'm not getting a sense that Mr. Kulakov is with us, so I think we should, in the interest of time, he can always come back later, but in the interest of time, I will then move on and invite Mr. Ankit Jain, the Senior Vice President of SBI Capital Markets from India. And then he can start also telling us a little bit about what he does and also weigh in the subject that we are discussing, giving us an appreciation of the Indian market and the ecosystem as such. Mr. Ankit, over to you. Thank you very much.
Thank you. I'm Ankit Jain. I'm a Senior Vice President at SBI Capital Markets. It's the investment banking arm of State Bank of India, the largest bank in India. And we, look at financing of various infrastructure and non-infrastructure projects. So firstly, I would like to thank the lead speakers on the presentations that they gave, and it was quite informative and detailed, capturing a lot of data points. Few observations from the presentation that transport and renewable are forming the bulk of investments that are being done. And because of the nature of both of them being capital intensive, so in terms of value, they tend to be higher in number. And also renewables is in focus because most of the countries are trying to achieve, move towards their target of achieving net zero status across various timelines and various targets. Digitization also, as mentioned, has picked up a lot of investment, and as the economies are growing, the digitization is increasing. The need for information security and data centers is also increasing. So that is also a focus area. Apart from these 2 or 3 major segments, there are other subsectors of transportation, energy, then urban infrastructure, social infrastructure, and additional digital infrastructure, which has formed an important part of the infrastructure sector, and a lot of projects are coming up in these segments also. One more thing that was, I think, mentioned in Dr. Mamiko's presentation was that pension funds have, many pension funds have, and it makes sense also to invest into the local markets first because of operating in the same currency. But and I believe that if the returns are sufficient to cover the currency risk and offer the returns required by the pension fund, so cross-country investments are also quite actively being done. Specifically, as mentioned earlier by one of the panelists, that infrastructure is a long game, and it requires long-term investment. So it makes sense that pension funds and insurance funds, that kind of long-term money comes into the sector to sustain infrastructure in the long term. So that is essential. One more thing that was mentioned in the presentation was that by Mr. Henry, that the cost of infrastructure or cost of construction is increasing over the years, and this has also increased the cost of infrastructure and subsequently the impact on end user and economy. That is true, and to some extent, I think along with focus on infrastructure, there should also be focus on the ancillary or core industries manufacturing segment that supports the infrastructure. So investment has to also increase in those segments. Infrastructure being, as everybody is aware that it's being it is in long-term in nature, and also there may be some aspects of infrastructure projects which required public resources to fund them. As mentioned by the Honorable Minister of Finance at the beginning of the session, that public money may not be sufficient to cover the entire length and breadth of infrastructure investment. So I think there should be clear policy and regulatory regime to attract private partnership, and we have seen that once the model like documents or the policy is standardized and the risk reward benefits are properly allocated amongst the private sector entity and the regulator or the authority or the government. So it attracts a lot of investment from the private sector partners, which ultimately, because all these policies have to result into an attractive proposition for the private sector also, and for that private sector entity to raise funds also. So it should be a financially viable proposition. So that also will go a long way in covering the gap in financing that is being spoken of. Apart from that, as Mr. Henry had mentioned, that although because of various reasons and the global factors, the fundraising has declined substantially in the first half of 2023. But as he also mentioned, that there is a sufficient dry powder available that is floating around. So I think from a financing perspective, if there are opportunities which are attractive, then investment would definitely come into those opportunities. In addition, there was a mention of how the complexities and costing or data points for pension funds are a prohibitive factor for investment. So I think as I mentioned earlier, that as the policy and the arrangement of bringing in the private sector participation becomes more standardized and more transparent, this prohibitive impact should also go away, and it will help the funds also to deploy or diversify their risk into new emerging markets. And I think that's it from my side. Thank you.
Thank you very much, Mr. Ankit Jain, for also reflecting very pointedly on some of the various respects that were made in various presentations and insights by the panelists. Apologies, earlier Mr. Kulakov had challenges with his technology, but I think we'll continue on the India framing, and then we'll come back to him and give him also some time to weigh in on the subject. So without wasting time, Mr. Prasad Gadkari, over to you, and thank you very much for joining us.
Thank you, ma'am. Good evening to all of you. I hope I am audible.
You are very audible. Thank you very much.
Excellent. So maybe I'll just quickly take off from where Ankit has left, and I think he's, well, at the outset, my gratitude and thanks to the organizers for inviting us for this prestigious infrastructure investment symposium under the BRICS umbrella. What I want to quickly probably try and do is really unpack 3 or 4 things. I'll tell a little bit about NIIF, which is the National Investment and Infrastructure Fund of India, And then I want to touch upon a little bit on the Indian government's approach to infrastructure development over the last several years, and especially on attracting private capital. What kind of structures and instruments specifically have got created. And maybe then I'll close with what are the areas where maybe more work can be done so that the country can attract more private capital. So those are the 3 or 4 things I want to touch upon. So starting off, firstly, my company, it's called the National Investment and Infrastructure Fund. So we are an infrastructure fund which is anchored and created by the government of India in a joint venture with large global institutional investors. So we are technically a private entity, but really 49% owned by the government. So a very strong support and active work that we do with the government. And in collaboration with some of the largest global investors in the world. So our investors include, some of the largest Canadian pension funds like CPPIB, Ontario Teachers, PSP. We have the largest Australian pension fund as one of our owner investors, which is Australian Super. We have the largest sovereign wealth funds like Abu Dhabi Investment Authority and Temasek of Singapore. We have the US government through their arm called DFC as an investor. And we have some of the Indian financial institutions. So that's the really, this, in a way, we are a public-private partnership ourselves, which is a word we all use in the infrastructure context. And we have been created really to channelize global capital into the Indian infrastructure ecosystem. So that's really the purpose of our creation. Today, we manage 4 funds and we manage about $4.9 billion of equity. So that's really what the capital that we manage as an institution. So moving on to the next part of what I want to talk about is really how has the government approached infrastructure, especially if I look at last 5, 7, 8 years. Clearly there are 2 aspects which come to the fore. First is very methodically and I would say in a very active manner, the government has tried to put together a very programmatic approach to infrastructure development. So there are distinct programs which the government has thought through, planned, and put on path of execution. And there are 2 large programs which are going on. One is from a new development perspective. There's a program called National Infrastructure Pipeline, which is about a $1.3 trillion program which is going on. It started a couple of years back. Obviously, there's COVID a little bit in between, which has had some impact on the timelines. But I think more than the exact timelines, really what a program like this does is it helps every ministry, every state plan their projects. And there is a very central focus on it. There is monitoring which is happening from the country's highest departments. Ministry of Finance is very actively involved in monitoring and helping plan this program. So a very deliberate attempt for executing this large program is underway. And this program comprises across all sectors: transportation, energy, urban infrastructure, social infrastructure. So all of them are outlined under this $1.3 trillion program. The second program is really more for attracting private capital in operation and maintenance of assets, getting releasing government's capital through an asset recycling kind of approach. And this is called National Monetization Pipeline. This is roughly about $70 to $80 billion program which has been outlined and which has started last few years. And that again, where government is attracting private capital into brownfield as well as operating assets in roads, in transmission, in airports, in some of the sports infrastructure like stadiums and so on and so forth. So very, very interesting things going on. And at a big picture, I think what the country has been able to do over the last, I would say, a decade or so is, I think the private capital or private participation in infrastructure has averaged between 25 and 33%. At times it was maybe closer to 30, at times it is closer to 25. And aspirationally, I think clearly government wants to keep increasing that percentage, and there are a whole lot of efforts going on. So I think Ankit a little bit touched upon it. So we have regulators really in place for various sectors. We have standardization of contracts has been happening. There are payment security mechanisms put in place. So various measures have been put in place to really get this private capital up. And one more interesting facet which has actually happened and which has helped is really the approach has been to customize or tailor situations or products which will attract various kinds of players, because all of us know in infrastructure, you have contractors, you have developers, you have then private equity funds, you have pension funds, sovereign funds. you have passive investors. Everybody is coming with a different approach. Their risk appetite is different. So what the government of India at least has done is they have customized structures and created different products which will attract different pools of capital. I'll give you maybe 1 or 2 examples in interest of time. Say take a sector like highways. Government has maybe 3 kinds of products for the highway sector. For new projects and greenfield projects, you have the regular, what is called the BOT or the DBFOT scheme, which is where, it's a build, operate and transfer. Private sector comes, constructs, operates, and then transfers it over a 15-20-year period. And this attracts people who have greater risk appetite and so on and so forth. Then there are some people who do not want to take toll road market risks, traffic risks. For them, the government has created what is called hybrid annuity, or they call it HAM kind of contracts, where there is an upfront grant which comes from the government and there is an annuity over a long 15-20-year period. So you have to take construction risk, you have to take operating risk, but you don't have to take traffic risk. And this program suits construction companies who do not want to take these traffic risks. At the other end of the spectrum, there is a program called TOT, which is called Toll, Operate and Transfer, which is really attracting pension funds or infrastructure funds who are good at operating or doing traffic analysis and financing analysis and structuring new instruments, but they are not good at construction. So Toll, Operate, Transfer is really a kind of a sale of operating assets to these long-term investors. So that's really an approach which has helped attract. I've heard Mamiko spoke about attracting pension funds, and I think India has been able to attract pension capital, sovereign capital, insurance companies, globally to come and invest because of the structuring of products. There is a new product which is a financing product called infrastructure investment trusts. And I heard my colleague from China talk about REITs. InvITs is what we call it in the Indian market. These are really securitized structures for listed instruments in infrastructure. So you don't have construction risks, but you will have to take market risk and you will take operating risk, and you can make a passive return out of it. So this is a great instrument really for passive investors, and InvITs has probably been able to get garner about upwards of $10 to $15 billion in a short time frame in the country. Then our own company, which is NIF, is a new creation. We are a 6-year-old company, which is really created. I told you we manage close to $5 billion, especially to attract global capital into Indian infrastructure. Then there is a new institution called NAPFID, which has been created, which is giving long-term financing for debt for infrastructure. So this approach is really this tailoring and customization approach, I think has worked very well for the country. So overall, I think directionally, I would like to think that India is a very vibrant infrastructure investment market. We have all kinds of players globally, as I said, from North America to Europe to Australia, Southeast Asia, Middle East, Japan. All of these investors are coming. We have strategics from Europe. People like Zurich airports are coming and doing greenfield airports. We have Dubai ports, which is doing greenfield container terminals. Then the pensions and the sovereigns I've already talked about. So I think all of that has made the market into a very vibrant market. As a player who's on the ground and very actively involved in infrastructure, I would think, there's a lot of effort and some fantastic work which has happened over the last few years. There's a new department created under the government Ministry of Finance called Infrastructure Finance Secretariat and Infrastructure Cell. I think that's a great move which came about a year back, which is really helping the sector resolve some of the underlying issues, standardizing of contracts, interfacing with various players. That's again a new initiative which has come in. What could be done better? I would probably touch upon that and then close my talk. I think there is scope to do even more. As I said, one area of action to our mind is clearly the portion or the proportion of domestic capital which has come into the Indian infrastructure from the domestic pension funds, domestic insurance companies. I think that is slowly starting to increase, but clearly there is scope to do more. And specifically, government relaxed some of the policies in this sector 2 years back. And I think, if there is a focused effort given on this is where, globally 5 to 7% from pension funds and insurance companies comes into this sector. For India, I think that percentage is on the lower side right now, but that's an area where government can clearly do more. And I think they are really seized of the matter. The second area to my mind is creating maybe even robust pipeline of asset opportunities. Today, all these programs are there, and I think that is clearly providing already fodder for all these players. But if we can provide and increase the scale of opportunities, because a lot of capital is looking at the country, we ourselves talk to a lot of investors. And if we can create a good pipeline over the next 3-5 years for these institutions to invest, I think we will be able to do a great job. So that's really maybe the second area. Alongside this, especially for greenfield projects, new assets, I would say maybe one can improve the project preparation efforts which are going, and I think again Ministry of Finance is seized of that and they are working on it. But that's an area of work where the government can work with various line ministries and improve the project preparation, DPRs, feasibility reports, and if you present a very tight package, I think that gives a lot of confidence to global investors, private investors to come and participate, and maybe that's an area one could look at. And the fourth aspect, I would say, again, some of my colleagues spoke about before. I think important areas globally, I think as countries are growing and especially developing economies improve their, their scale of prosperity, urbanization is growing, and therefore there is need to focus on urban infrastructure. There's need to focus on healthcare. And if there are ways, if the countries can focus on attracting more capital into urban infrastructure, because urban healthcare have their own peculiarities, but it's a problem which can be solved. I think some focus on those aspects as to how do you bring more private capital, that will really help. I think those were the main points I wanted to share. Happy to take if there are any questions, but thank you.
Thank you so much. That was really comprehensive, and I mean, I'm trying to limit everybody to 5 minutes, but because there's just so much that you can share, I'm allowing it to go on so that we can always know which areas you are able to assist, because the idea is that the conversations will take place in this platform, but they will also take place outside of this platform. So it's to give people the areas of expertise and where you've succeeded. But I think it's very clear that the programmatic and systematic approach to infrastructure development in India has borne more fruits for India and the vibrant infrastructure market that we're seeing equally. But I like the fact that you're able to customize and look at de-risking when you're considering private sector participation in the infrastructure development. And I think very much so we'll reflect before we close today on some of the areas where we can do better. And definitely local capital markets do play a very huge role in terms of supporting infrastructure development, robust pipeline planning, project preparations that you've raised, and some of them were raised by other panelists as well. So we'll reflect on those at a later stage. Let me invite Mr. Kulakov. I think he's now able to join us. Thank you very much, Prasad, for the presentation. Apologies, I understand that you were not properly connected to be able to reflect. It was not because you did not want to speak to us. So let me allow you to then come through and give your perspectives as well. Thank you very much.
Thank you. Hello, everyone. First of all, I'd like to thank you for opportunity to participate in this BRICS Infrastructure Forum. I think it's crucial to all of the state members to collaborate together on the topic of infrastructure development and to share common challenges and barriers we need to overcome to provide sustainable future for all BRICS members. I'd like to thank our speakers first. It's really important to understand global trends in infrastructure development that will help us to increase the scale of private investments in this sector. So thank you, Dr. Mamiko Yoko Orai and Mr. Henry Bless and other speakers from South Africa, China and India for this insightful data you provided. As mentioned before, I work as a head of public-private partnerships at one of the bank institutions, and my job is to ensure the infrastructure sector is development at a desired pace in Russia. So I would like to share with you some knowledge of how we are coping with the problem of investment and traction in Russia. Our infrastructure sector is not as big as we all desire. It's around $55 billion a year. So as all you know, it's very important for government to support local infrastructure projects since they provide additional socio-economic effects. And these effects are new jobs, more taxes for the government or for the regions, it's higher salaries for people and better living for all at the end. But the problem is that the resources of the government are very limited. and it's impossible to support every infrastructure project in the country. Ability of pension funds here is also limited. So in Russia, we created infrastructure bonds, the investment product that helps to attract private investments, as well as receive government support to infrastructure projects that are vital for economic development. So how do infrastructure bonds work? Simply, we created a subsidiary of Russian development institution that provide bond issues on the market. Bondholders receive bonds with a market yield, it's around 10% a year, and have a state corporation guarantee as a security mechanism. Bondholders are mainly banks, pension funds, and individuals as well. So this subsidiary that is created by the government corporation then use the funds provided by the bond issues to the infrastructure projects that are in need of private financing. The great thing about this provision of funds is that it's given on for the project at the very low rate, around 4 or 5% a year. And the difference between the market yield of bonds and preferential rate for the project is compensated by the government. As a result, we created an instrument that helps to attract private investments, provide preferential rates for important infrastructure projects, and also help to reduce the government spending in comparison to direct government financing. So currently, this program has attracted almost $1 billion in bonds and provided state support loans for more than 30 projects in our country in sectors like utilities, transport, roads, social infrastructure, schools, kindergartens, stadiums. So to sum up, I guess now it's time for more sophisticated ideas that will help to provide the desired level of government participation, as well as private investment involvement in area, in sector of infrastructure development. And I think it will help all of member states to create sustainable future for the next generation. Thank you so much. That's everything I wanted to say.
Thank you very much, Alexander. Much appreciated for that succinct insight and sharing of your perspective. I think I've taken a bit of time on the questions, so I would like to maybe at this point to allow others to come through where they believe that we have not sufficiently covered, and there are burning, pressing questions in relation to what has been shared, the wealth of insight and information, and areas that certainly going forward, we can look at different models and collaborate better and bring some of those lessons into our respective areas. So if there are any questions at this point, please, you may raise your hand, and let's get the panelists to, to do a little bit of heavy lifting and help us in addressing some of the questions that you might have. I don't see any hands at this point. Let's give it a moment. You may also put your question on the Q&A if you do not want to come through, and we can read it out for the panelists to tackle. You indirectly promised me active participation, so our panelists have done the heavy lifting of laying the groundwork and contextualizing the global trends and some of the work that they're doing in the various countries. So I definitely think we should have a pressing question, unless they have done such a wonderful work that you feel like there's no questions that you would like to pose to them. Okay, I think I have given it enough time. There is, okay, I see there is one hand. Your name is not very clear. Is it Mpasiri? Please, you may go ahead and pose your question. And let us know where you're from. Over to you. Looks like you are having challenges. I am not sure. Maybe IT can assist. Okay. There is in the meantime, there is a question while I'm waiting for Mpasiri to come through. There is a question from Tabo, and he would like to, he would like to thank all the panelists for and the moderator for the presentations that have been made. The question that he would like to ask is how do we bring all of these ideas together? So while you're thinking about that, I will take Mpasiri and I will allow any of the panelists to come through and think about how do we bring everything together. Mpasiri, over to you.
Yes, good afternoon. Can you hear me?
Very well, thank you very much.
Well, firstly, let me start by introducing myself. My name is Tinashe Mpasiri. I am a member of the Banking on Africa's Future, which is a network of individuals who come from diverse backgrounds, and their passion is to ensure we secure the future of Africa through exchanges of personal experiences, insights, and trading ideas, so as to inspire new thinking, new outcomes, and new possibilities. I would like to thank you, the program director, for directing this webinar this afternoon, and more importantly, all the panelists that have participated and shared wonderful insights in as far as bridging the infrastructure gap when you look at Africa, and not just Africa, it's a global phenomenon where we face challenges when it comes to the aspect of infrastructure in it enabling the delivery of the promise of business and life. So just looking at these conversations that have been taking place, and more importantly, what caught my attention, or rather what actually was ignited by these conversations in as far as the financing of infrastructure is concerned, is that when I look at one quote that one remarkable man once stated, he stated that the opposite of poverty is not wealth, and that it is the rule of law. And absent the rule of law, economic development is a mirage. So when we look at the aspect of just development, in infrastructure development and economic development, there is a causal link, and there is a causal link between the rule of law and economic development. And just looking at the aspect of respect for the rule of law, and more importantly, regard for property rights, just looking from a financing perspective of infrastructure, is enough being done to ensure that there is respect for rule of law, and more importantly, regard for property rights when you look at the African continent, and when you look at individuals who happen to be in the space of infrastructure financing, and more importantly, asset managers, and even those, particularly asset managers. Are there any individuals that actually can speak to this aspect of ensuring that the rule of law is respected, not only in South Africa, but throughout the continent, and ensuring that there are points of light or these shining stars or examples that we can look up to, who are democratizing knowledge around the causal link between development and the rule of law in regard for property rights. And to close up my my questions that I have. That being said, in as far as identifying those individuals, what role then can such conversations play to ensure that at the end of the day, we have such individuals that can speak to the aspect of the importance of the rule of law? Because when I look at just investment, at the attractiveness of investment, I think of the relationship between meat and flies. Good meat attracts flies. They will come on their own. The meat does not have to invite flies to say, come, come. So even a country or a region where the rule of law is respected, where property rights are regarded, it will obviously be an attractive investment destination that doesn't need anyone to say, come and invest in this particular region. So that's from me in conclusion.
Thank you very much, Tinashe, for your contribution. I think we'll start with that one. If any one of the panelists would like to reflect on the rule of law, property rights, and how it relates to, infrastructure development and economic development, and then we'll wrap it up with just looking at, if each one can just come in with one or few aspect of how do we bring everything together in relation to, infrastructure development and some of the aspects that have been raised that are critical levers for infrastructure development. Dr. Mamiko, thank you very much. I assume you'll take the rule of law and just see if we can assist Tinashe in terms of how that can be tackled. Thank you very much. Over to you.
Yeah. Thank you very much. I think this is a fundamental question, but I think there are also been experiences globally that have actually been able to improve upon this critical question. But I think and I think this is what you're getting at, without the rule of law and the property rights, the contracts around infrastructure development can really not take place. So I think it is fundamental that the rule of law can be established. And I think another area is concessions. If the government were to change and if the agreements will be removed, obviously this is the political risk that developers may not be able to take. And it all comes down to a cost, because if these risks are taking place, it adds up to a cost to the project, and therefore it becomes more and more expensive. So I think it really comes down to this. But having said that, I think Asia proposes a really good example in terms of some of the countries that are really emerging, Vietnam, Indonesia. I mean, these countries have undergone really sort of quite revolutionary changes in terms of the rule of law. Because I remember when I started working as a professional, these countries were still very much in a sort of area that property rights may not be respected. But I think at this point, there's no doubt for investors' mind that these areas of rule of law have really been stabilized, and it has become a really viable market. And I think these are reflected in the investments that are being made. So I think there are good grounds for these issues to be addressed. And I think there are means that really with the political stabilities, these can be sort of improved. So I would just say that it is a critical issue, but without that, probably some of the fundamental issues can really not be addressed. And I just bring Asia as an example. Thank you very much.
And maybe, I don't know if I put anyone on the spot as we wrap up, because I would like to give all of us a body break since we've been at it from 12. But maybe Hans, Henry, Blas, you've had an opportunity to listen to everybody, some of the contributions, and you've brought some of these trends together. Maybe I can start with you and ask you to reflect a little bit, and in terms of how do we bring everything together. There's so many ideas that have been put on the table. There are so many experiences, so many lessons and learnings that we can take, but how do we bring all these aspects together?
Thank you. I mean, it's a very broad question. I think one that many at once sort of solve, and I don't think, as I said, I don't think there's like a silver bullet. There are very important things. I mean, the first one is obviously sort of good good planning, so investing in sort of not only project preparation, but also sort of strategic planning at sort of country level and sort of city level is absolutely critical, because otherwise we still, and not only in the emerging market, actually, all around the place, we're still seeing sometimes projects that get off the ground because there's no other project available, and they might not actually optimize all the, achieve all the outcomes that we want. So I think planning and investing in sort of, systemic understanding of issues and planning so that you can focus on the project that actually deliver the most outcomes. I think that's critical because government money or DFI money is not infinite, and so I think we need to optimize that. So I think the planning is very important. I touched on sort of markets and standards, etc., and that's kind of linked. Understanding those markets and the requirements of international investors that are constantly evolving is also very important. The last thing you want is prepare a project and sort of miss out some of those key elements just to get the market to tell you, sorry, because you haven't done this, you haven't done that, we can't invest in that in that project. And some of them are regulatory in nature, some of them are emerging, especially around carbon sustainability in nature. But I think keeping track of those is critical. So probably get plans, understanding the sort of requirements of the market. Third is the enabling environment, which I think we touched on the rule of law. And I think here it's very important to understand investors have memories, and sometimes it may feel tempting to, on one project, to make an exception, and because you may have good reasons, but I think unfortunately one project can actually deter investment for a long time, and so really sort of being careful about sort of rule of law and sort of making sure that whatever is in contracts stays as it is, because we've seen that, I think, in a few markets, but I think most markets sort of evolve from that. I think we had an example from India, where actually the programmatic approach, which basically erased uncertainty, has actually created a very, very mature market, to the point where we're discussing the other day with some major investors, and they almost define India as this developed market when it comes to toll roads and renewables to a certain extent. So I think really sort of creating that predictability in the market, the certainty, is absolutely critical. Same thing we've seen, I guess, the mix of embracing sustainable finance and sort of creating predictability as well in China with the growth of green bonds that have been very, very successful. And I think the last point, which I mentioned already, is sort of working with DFIs and private sector to sort of consider innovation and not being sort of close to it. Obviously you don't want to sort of be the first one to try a new ways for financing projects, but there are constantly new ideas and so new ways of doing things in other places that might be worth learning from. So I think those probably will be the 4 points. There's obviously a lot of them. But again, I don't think it's silver bullet. Unfortunately, you do need that planning, understanding markets, enabling environments, and sort of being on the lookout for innovations in order to be successful.
Thank you very much. Much appreciated, Henry. I think I know it was much broad, but it's always good to also reflect on this broad aspect. Let me just circle back and say, 1, 2 from the panelists, anyone who would like to add, if they can come through, you can just switch on your camera and come through. I think that's the easiest way of if you want to add anything to the last question, or even the initial one. Okay, I think we have covered sufficiently then. I don't see anybody who would like to weigh in. Let me thank the lead speakers for the comprehensive presentations that they've made. Those were really, really good in terms of contextualizing the ecosystem and where we think infrastructure is, because the how and where becomes easier once you kind of understand the base within which you're working in. And also thank our panelists. I think very diverse group, very rich insight from South Africa, from China, Russia, and India. And I think these conversations will continue to take place outside of this platform. I think that is the real purpose of that. We would not be able to address every aspect of, how do we conceptualize and in practice think about scaling, infrastructure and ensuring that the pace and the scale quality of infrastructure investment come to the fore. I have taken time, and I will ask that we take a body break from 2:45 until for 15 minutes until 3 p.m. Then we'll start with session 2 at that point. And so I think we'll carry on like that and just give you a break, and then we'll proceed with the next session. That is very exciting as well. It starts to look at different partnership models to support infrastructure investment. So I hope that you would not go away for too long, that you will promptly come back at 3 p.m. and then we can run the second session until 4:30. So thank you very much to the panelists. Thank you very much to the delegates. You have been very graceful, and you've really helped me in terms of the house rules. We have not had major challenges in trying to hear each other and make sure that we have an effective conversation. So thank you very much. We adjourn and we'll be back at 3 p.m. sharp.
Thank you so much.
Thank you very much. Let me check. Mr. Baldeo, are you going to come first, or is Mr. Andre Donskoy going to come first?
Good evening. I am Baldeo Purushart. I'll speak first. No problem.
All right.
Thank you.
Thank you so much.
Thank you. So I will speak afterwards.
Is it okay?
Yes, sure.
All right, great. Thank you. And you've got time, you've got about 25 minutes. So don't feel rushed, because I feel like the lead speakers can just anchor the discussion and cover a whole lot of ground. And then the panelists can just also come in, share their insights. So that's good. I think we'll be starting in just about 3 minutes. So we'll wait for others to come back. Thank you so much. All right, welcome back. It is 3 p.m. in Johannesburg, so I think we can start. This next session looks at partnership models to support infrastructure investment, and public-private partnerships and blended finance are widely used instruments to catalyze private sector capital for public infrastructure investment. And these instruments are also known to have a stronger track record in effective infrastructure delivery relative to traditional financed product. However, their use is quite inconsistent across BRICS countries, and we believe that there are opportunities to share the learnings and insights in that respect, and see where they are working well and where can we learn best. So this session will use BRICS country case studies to discuss the triple Ps and blended finance instruments, and also see how those can be promoted as effective partnership models of what can underpin success in infrastructure development. We'll also explore partnership models that can enable greater private sector participation, and what kind of regulatory reforms it would take to enable the private sector participation in relation to the triple Ps. So we do have lead speakers as well, similar format. We have lead speakers and we also have panelists who will also share and weigh in. And our lead speakers are from India and Russia. We'll start with Mr. Baldeo from India, and he's the Infrastructure Finance Secretariat at the Department of Economic Affairs, and he will lead us into this session, and then he'll be followed by Mr. Andrei Donskoy, who is the Director of State Development Corporation from Russia, and then thereafter we'll move into the panel. So if I can hand over to you, Mr. Baldeo, to take us through your presentation. Thank you very much. You are on mute. You are still on mute, Mr. Baldeo. We can't hear you.
Am I audible now?
You are audible. Thank you very much. You may go ahead.
Thank you very much. I must congratulate South African presidency for having this symposium today, and also for selecting very apt themes for this symposium. PPP, blended finance, various models which can make this thing successful are need of the hour. And in next 20-25 minutes, I'll discuss various partnership models which we are taking up in India. And when I'm saying in Indian context, that is how we are taking up here. Otherwise, they are general in nature, universal in nature, and they can be used by any country with required modification here and there. In this session, I have my senior colleague, Sri Amit Kumar Ghosh also. He's Additional Secretary in Ministry of Road and Surface Transport, and he is looking after road development program, including PPP mode. Next. Next. Next, backward. So during this presentation, I will roughly touch upon 3-4 important points. That is India and PPP, India's PPP journey, then prevalent PPP modes in India, key initiatives of the Government of India, and factors ensuring PPP success in India. Next. This is roughly the journey of PPP in India, and it has all started 1991 onwards, when the economy was liberalized. Before that, majority of infrastructure development, or if I would say almost all infrastructure development, was with the public sector, with public financing. And the debt market was also not very developed. But in 1991, we liberalized our economy, and then in infrastructure, the entire endeavor of bringing private finance more and more had started. Subsequently to 1991, we have started a large national highway development program, including PPP modes, to develop our national highway as world-class national highways. Full screen kariye na. And back. Then somewhere around it, we have also come up with Central Road Funds as a statutory act to support this road development program. Then in 2000 onwards, we have come up with PPP Appraisal Committee, which was a kind of regulatory setup to ensure discipline and standardization in PPP. And we also started viability gap funding scheme to support those PPP projects which are economically desirable, but commercially unviable. Subsequently, around 2006, we have come up with PPP cell, which later on developed into Infrastructure Finance Secretariat. This cell was single point nodal mechanism to promote PPP policy and program in the country. And then at the same time, we started development of model bid documents, which includes model concession agreements and RFQs and RFPs, etc. We also come up with a scheme of infrastructure project development fund to support transaction advisor cost borne by project sponsoring authority, so that better project could be prepared. During 2010 to 15, we have launched a variety of number of infrastructure development funds, which were mainly for takeout financing, and they were to give cheaper funds to PPP projects in post-COD phase, when the project is fairly de-risked and cheaper fund could be given. Subsequently, we have allowed FPIs to invest in alternate investment funds. We have also set up our own sovereign fund, National Infrastructure Investment Fund. And during this time, initially when we come up with the road PPP projects, mainly in the DB-FOT mode, we saw a gradual decline because of a variety of reasons. And then we come up with a newer PPP partnership model, which was hybrid annuity model. And in 2018-19, we allowed FPIs to buy bonds. We have also allowed banks to do credit enhancement facilitation for bond issuance, so that bonds get better results. And recently, we have taken up a number of initiatives, including setting up of Infrastructure Finance Secretariat and setting up a new development finance institution, which is called NAVFed. And we have also come up with newer models in newer sectors. For example, PPP was not happening in social sectors. And in recent years, we have pushed PPP in social sector with very, very successful results. So this in brief is the India's PPP journey of last 30 to 40 years. Next. And in the recent past, in last 5 to 10 years, we have taken up PPP far more seriously, and we have put a lot of focus and attention because of a very simple reason, and which I think many of the country in their development path are facing this reason. And that is the difference between how much investment you require for developing quality infrastructure in country and how much public sector can fund, and what is the gap. So these are some of the figures which showcase that by 2032, the rough requirement for India's investment in infrastructure would be somewhere around $4 to $5 trillion. And out of that, the gap would be somewhere around $300 to $500 billion, which is a humongous gap. And to bridge this gap, only public sector efforts will not be sufficient. And we have understood this fact that private sector support in terms of infrastructure financing, in terms of infrastructure investment and development is very much required. Next. And to ensure that, on the one hand, we have started increasing public financing for infrastructure. And you can see that in last almost 10 years, there is a 3-time enhancement in the capex expenditure by government. For at the national level, it's 3 times. At the sub-national level, it's almost 2 times. And that is a substantial increase. In last couple of years, almost every year, we are increasing 33% year-on-year increase in capex investment. That gives us the lever to bring more and more public financing into infrastructure through a variety of models, including blended finance and PPP models. Next. So what PPP does for a country's development, what it brings. And these are some of the things which we must understand that, of course, on the one hand, it brings acceleration in investment opportunities. In addition to public investment, there are humongous and substantial private investment also. But at the same time, it's bring few very innovative and interesting things. For example, private efficiency ensure faster implementation of infrastructure projects. Then it also ensures reduction of life cycle cost. In a PPP model, generally we consider infrastructure development in a life cycle approach, not merely creation of the infrastructure asset, but also taking the the huge and operation maintenance of infrastructure project as an integral part. So it's a life cycle approach towards infrastructure. And then it is based on optimal risk allocation. Which risk is to be borne by which entity, private or public? And the cardinal principle is whoever is better to bear that risk, he should have that risk. And our idea is that by bringing more and more PPP and infrastructure development in the country, on the one hand, we are promoting inclusive growth, which is one of the target of our Viksit Bharat 2047 target or Amrit Kal Bharat target. Because infrastructure is something which is used by everyone, irrespective of caste, creed, gender, or any kind of divides. It is used by everyone. Then also infrastructure promotes higher multiplier effect for the economy. And in the short term, it's roughly around 2.4 to 2.5. In long term, it goes much more beyond that. And then it creates job for every kind of skill sets. So these are the ideas which are basic ideas on which we have built our edifice of promotion of infrastructure through PPP mode. Next. Now, which are the models we are following in India to ensure that PPP are happening not only in every infrastructure sector and subsector, but also they are an response to the requirement of that project. Every project has different requirements, and we have to find out a model which can be the best model to satisfy those requirements. And in India, we are almost doing every type of model possible in the books. It is very difficult to put every model in a precise taxonomical definition. It is difficult. Every day new models are coming, all sort of tongue twisting acronyms are coming. But if we take cardinal risks into consideration, then we can probably put these models in 3 broad categories. Next. And on this graph, if you see on the one side, what is the opportunity for public sector to invest and what is the opportunity for private sector to invest? And as models go up, more and more opportunities are available for the private sector to invest. This is the vertical indicator. And on the horizontal indicator, it is how much risk, obligation and ownership is borne by the public sector and how much by the private sector. As we go towards develop, better forms of PPP engagement, you will find that more and more risks are being taken by the private sector. And we have categorized this risk. There are 4 cardinal risks. One is who owns the infrastructure, ownership risk. Next is back. Next is who takes the risk of design and construction of that infrastructure. The third is who takes the risk of operation and management of that infrastructure. And fourth is who takes the risk of financing that infrastructure. These are the 4 cardinal risks. And as those risks are being covered by private sector or public sector, you get different models. And that is why there is a variety of models possible because of the various permutation combination of these risks. Next. So the first type is of those models where there are limited private participation opportunities. Mainly, the infrastructure is developed by the public sector and private sector is coming there just to take up very small role. And one of such model is service contracts, where private sector is coming just to do any particular service work or particular work assignment. And the concession period is also not very long. It's from few months to few years. And for their work, they get some kind of predetermined fee. These models are prevalent in road toll collections, installation and management of water meters or power meters, waste collection, etc. And one such project I have showcased here is a garbage collection project in Jhansi Municipal Corporation, where the concessionaire is collecting solid waste from more than 100,000 households and around 10,000 commercial shops. And in lieu of that, he gets monthly charges from these households. And here the minuscule operational risk is taken by the private concessionaire. All other risks are taken by the public sector. Next. So similar to that, there is another PPP model, which is called operation and management contract. Here again, all the other risks are taken care by the public sector, and private sector is only taking the operation and management risk. Because operation management is little larger than a smaller work assigned, so here the concession period is also longer and more responsibility on the private sector. I have given an example of Mysore City Corporation, where the private sector has taken the operation and management of water facility. And the scope of work is that 100% household will be provided 24/7 water, which is intermittent supply at present. There would be 20% improvement in samples meeting the quality targets and 15% decrease in non-revenue water. With these kind of operation and maintenance role, the private sector will get fixed fee for operation and management. Next. And the third model is where the infrastructure is developed by a public sector, but it is taken over by private sector for few years on leasing mode. And there they develop it, they do their part, and whatever money they are earning, they share a part of that with the PSA or project sponsoring authority. Next. The next 2-3 models are models where there are larger role for the private sector to perform, and this is called integrated project development and operation opportunities, where they are also taking the design and construction risk, but they are not taking finance risk, they are not taking ownership risk, and generally the payment is based on some form of annuity. For example, this is a road sector where the road is constructed by private sector, maintained by private sector. In lieu of that, they are getting biannual annuity for their expenditure. Next. Similarly, we have come up with a very innovative model, which is called hybrid annuity model. In the annuity model, entire expenditure is upfront done by the private sector. Later on, they get it from the government authority. Here, upfront government authority also share 40% of their investment, and that brings down the cost of capital, and that also increase the market trust in the project. And with that, again, the model is same. Private sector is constructing and maintaining the road. In lieu of that, they are getting annuity payment on the annual or semi-annual basis. Next. Then we come up to the fuller or pure PPP kind of arrangement, where majority of risks are being taken by the private sector. And one such partnership model is Humda, where there is a ready-made asset by the public sector, but the private sector comes and take that asset, further develop it as per requirement, and do the operation and maintenance part. And we have done it in 6 brownfield airport projects, where the private sector has come, they have taken the airports, they upgraded the airport as per requirement, and in future also as per various KPIs, they will keep on upgrading it. And in lieu of that, they are getting the various fees, etc. from the users, and they share revenue with the government. And also they have been given land, city-side land development for commercial development, through which they are getting non-aero revenue. Next. Then there is a DB Fort model. Everybody knows that here, except that ownership risk, all other risks are taken by private sector. They do the construction, they do the financing, they do the operation and maintenance. And here they share some revenue with the government authority. For example, there is a greenfield airport in Noida, which is developed in this mode. And here the same aero and non-aero revenue is kept by the developer, and they share a revenue share with the government out of this revenue. Next. And this is again very innovative model, where even ownership risk is taken by the concessionaire itself, and they bring the asset, they design it, they construct it, they finance risk, they take operation and management risk, and they get assured payment by government. Here we have developed a number of silos to store grains. Under this, the silos, they are getting fixed payment by the government, irrespective of the quantity of grain they store, and they also get variable payment depending on how much grain they have handled. And after the concession period, the asset will go back to the concessionaire, it will not come back to government. So this is again very innovative model, which is successful in many of projects. So these models basically, they explain variety of models. These are the specific models, but these models could be implemented with tweaking here and there in a variety of projects that we are doing it in India in a number of projects. These are the sample projects which I have showcased here. Next. But any such models, the consideration of model, the implementation of model, the success of model is not depending entirely on the model itself. It also depends how much government is supporting the entire initiative of PPP mode of infrastructure development. And here Government of India has taken a variety of steps and initiatives which has made these models successfully implemented in our country. Next. And we have taken one, as I have discussed, that we have set up IFS, which is a one-stop solution for all infrastructure policy and program as far as Government of India is concerned, under which we have taken variety of initiatives. Some of the important are programmatic support, knowledge creation, capacity building, and regulatory framework to put in place. Next. Under the programmatic support to infrastructure development in PPP mode, we have taken again a variety of initiative. One is that putting more capex expenditure, public capex expenditure. Second is to come up with a humongous pipeline of infrastructure project, which is called National Infrastructure Pipeline, under which we are having more than 9,000 projects. More than half of it is already under implementation. The total outlay is around $1.5 trillion. Then we are also having a national monetization pipeline of brownfield projects, which are post-COD projects and ready for private sector to take up. And through that, we are expecting to generate $75 billion resources for Government of India. Then we have a PM Gati Shakti master plan, where we are plotting infrastructure, various infrastructure on a 200-tier map to ensure the gelling of infrastructure with each other, and one infrastructure is complementing other infrastructure in a way that the combined effect is multifold. With that, we have also promoted various kind of financial mechanism through development finance institutions, through promoting newer infrastructure instruments like REITs and InvITs and IDFs, allowing tax exemption to solid waste, to sovereign welfare funds and pension funds of other countries. So we are inviting countries to please invest in India, and you get exemption on your income for these investments. Next. The other part of programmatic support is giving viability gap funding for those projects which are commercially unviable but economically required. And we give some kind of grant to those projects to make it viable. Roughly, we are giving grant in shape of CapEx and OpEx. And till date, we have given almost $924 million of grant, which has made 5.5 billion worth of projects successfully implemented in our country. Then the other scheme through which we are supporting, because many of the project sponsoring authorities do not have the funding support to hire a quality transaction advisor. And through this scheme, India Infrastructure Development Scheme, we are supporting those project sponsoring authority through funding from Government of India. Next. So these are one of the VGF projects which have been made successfully through VGF support. This is a metro rail line. And we have, because any project could be successful if, you know, that the user charges is exorbitantly high. But to keep it reasonable, we give viability gap funding support, and it is made this PPP metro project line successfully implemented in our country. Next. Then this is again very important project where we have come up with social sector infrastructure project in the healthcare. And this has happened especially in districts which are little behind in terms of developmental parameters. And there we have set up tertiary care, greenfield hospitals with infrastructure, PPP mode of infrastructure development by giving viability gap funding in terms of CapEx as well as OpEx. And they get fee from patients subsidized as well as market linked fee. And they provide quality tertiary care comparable to any big city in those underdeveloped areas. Next. These are some of the cases where we have provided infrastructure transaction advisor funding support.
One is for setting up a data center in Goa, other is for setting up a medical college and hospital in Arunachal Pradesh. The PSA they were empowered to hire a quality TA only because this kind of funding support by Government of India. Next. This is very important because PPP is an issue of theory as well as an issue of practice. Only theory doesn't work until unless there are practical guidelines and instructions. The practitioner of PPP are not at ease to develop a required PPP model. And here under IFS, we have come up with a number of documents and reference guidelines to guide thousands of stakeholders who are working at various levels in national and sub-national government, who can understand what a PPP project is, how to appraise a PPP project, how to go about a PPP project, how to structure a PPP project, and most importantly, this waterfall framework, because all this model which I have developed, the first question comes in which model to select. And this guideline gives the instructions, the workable instructions for administrator, not for academicians, how to select a particular model for your project as per requirement of the project. And then we have a PPP India website where all the know-hows, technical supports, toolkits, and variety of knowledge about India's PPP initiatives are being showcased. Next. Then we have taken capacity building initiative to ensure that these models are well understood by people who are actually doing these models, who are actually implementing these models. And we have run up a variety of course programs in consultation with national and international multinational bodies. And these are self-learning courses in hybrid mode. They are book-based and they are online courses also, which can be taken up by anyone who is interested in developing its capacity in infrastructure, programming and structuring. Next. Regulatory framework, my friends, are very important. PPP cannot be a successful initiative unless there is a very, very robust regulatory framework who brings the discipline and standardization in the PPP implementation. And we are here having a very strong PPP appraisal committee and SFCs, this standing finance committees, to appraise a PPP project, and not only to appraise, but also ensure that all the learnings, cross-cutting, cross-sectoral learning, which are coming from variety of PPP models are going into structuring and better success of these PPP models. Then we have a standardized bid documents that brings a standardization. So market knows in advance that if a PPP project, for example, is coming in road, these are the terms and conditions going to be. These are the models which are going to be in those projects. So that brings a possibility of policy stability and market trust. Then we are also hand-holding variety of project sponsoring authorities in national and sub-national governments to ensure that quality infrastructure projects are being structured and prepared and brought to the market. And with all these, we have seen that PPP endeavor of national and sub-national government has reached to a greater height. Next. So what are the factors? I have come to last two slides of my presentation. What are the factors? There are variety of factors, but the most important factors are, number one, that there has to be a streamlined appraisal and approval process, which we are having in India. There has to have standardized bid documents, and otherwise every project will go in a different direction and there will be no stability and standardization in the market. But at the same time, you should also have enough scope for flexibility and innovation to not only select different kind of PPP models, partnership models, but to invent it also as per your requirement, which we have done in past many years. Then there has to be a knowledge ecosystem which helps people who are implementer and doers of PPP in the grassroots level, capacity building exercise, and a very balanced risk allocation. But my friends, above all, there has to be a political will. This is the most important factor in any democratic setup. Engagement with public sector is a critical issue. And until unless there is a political will to engage private sector in your development journey, all those initiatives and endeavor will not get the optimal result which we want. Next.
And these are some of the testimonies of what we have done and how India has fared in the field of PPP. World Bank report is there, which says that India is number 3 in the world in investment commitments. Then again, another world report says that it is largest private participation destination in South Asian region. And then we are one of the best in BIMSTEC region. These reports are just a kind of testimony of what we have done. As I said at the beginning of my presentation, what we have done is not, Indian in the sense that they have been only Indian in terms of their implementation and in terms of their innovation. They are Indian because we have implemented as per requirement of our project, as per requirement of our setup. And there we have brought an Indian element into that, but they are fairly universal in nature. It can be implemented by any country, any project sponsoring authority. And we, with having such much, much more experience and a variety of knowledge documents and a list of successful project implementation, we assure our full support to all our brother countries. If any one of our brother country thinks that we could be of any help in terms of bringing these things to you also, we are ready. Thank you very much. Thank you.
Thank you very much, Mr. Beldel. Wow, what a rich case study on the triple Ps. Thank you very much for sharing India's journey, the models that you use, how you think about theory versus practice, and also some of the success factors that you've highlighted. I think it is really enriching, and I believe that the countries that are looking to enhance their PPPs would not be able to look very far, because clearly the work that you've done is very substantive. The government support, I think it's very clear. Political will has to be one of those ingredients that makes it come together. The pipeline needs to be very clear. The regulatory framework as well needs to be in place. And I'm sure that some of the panelists will reflect on some of the issues that you've raised, but I cannot thank you enough. I think even the delegates would agree that that was such richness, and we were spoiled in terms of the insights that you were bringing around the triple Ps. At this point, let me allow Mr. Andrei Donskoy to come through as well and share his perspectives. And then after that, we will also still have some time to discuss with the panel in terms of some of the insights and how are they reacting to some of the aspects that you have placed on the table. Thank you very much, Mr. Beldel. Mr. Andrei, over to you.
Thank you. Thank you. Distinguished ladies and gentlemen, good afternoon. And dear symposium organizers, let me start my presentation. Thank you for this opportunity. Here we go. So I will be discussing the background of how it appeared, the project finance factory, its mechanism, some statistics, and finally questions and answers session, I understand, going to be later on. The slide presents the overview of VEB Development Institution. You can see the VEB is in the middle, and we are interacting with a number of ministries here in Russia, Ministry of Finance, Ministry of Economy, other ministries. On the left-hand side, you can see our family of VEB. There are different companies, such as Russian Export Center, Russian Small and Medium Business Corporation, and other companies. They support us in terms of providing specialized products such as insurance, export support, etc. On the right-hand side, you can see commercial banks. We do joint co-financing with them, and the money flow to project implementation, you can see in the bottom, the project initiators. But let me get back to the project finance factory story. Somewhere in 2016, we got together, VEB, ministries, first of all, Ministry of Economy, Ministry of Finance, together with major banks and investors, and started discussion how to promote project finance in Russia. What are the risks those stop from project finance to grow faster? And finally, where we came to is that the interest rate. That's the problem. The interest rate is floating. So the banks are charging this floating interest rate, and the rate is based on the central bank key rate. And if a project is long enough, maybe more than 10 years, then the rate fluctuates, and based upon Russian history we have here, it may go down below 5%, and it may be well above 10%. I have a separate slide on that later on. And it's difficult to finance a project with such unpredictable fluctuation during its loan life period. So we agreed that the authorities, the Russian authorities, the government, will support these kind of loans by providing a hedge mechanism. So the key message, the key advantage of the factory is this protection for the project, because the project entity will not be paying more than a certain maximum level of this interest rate to banks. And it's also protection for the banks, because the banks are going to get market compensation in full, partly from the project. And if rates on the market are high at that moment, then the other part will be coming through subsidies from the government. But let me get back to mechanics now. Here on the slide, you can see the syndicate loan of with the total project value I see here of 100%. We require that 20% is equity of the project initiator, and 80% is provided by banks, by VEB. You can see tranche A, and tranche B coming from commercial banks. We encourage commercial banks to finance more, so you can see that tranche A from VEB might be 10%, and tranche B up to 90%. And we are aiming towards such distribution of tranches at the moment. On the right-hand side, you can see, well, first reserve tranche and then selection criteria for project finance factory. Let me start with the simple, brief information on the selection criteria. The project value minimum level is 1 billion rubles, which is an equivalent of $31 million. So we are thinking of certain size projects. Payback period of the project should be maximum 30 years. And loans, we are prepared to provide jointly with commercial banks of up to 20 years. And as already previously mentioned, the equity is at least 20%. But coming back to the middle, to the reserve tranche, that's another important element of the factory, of the project finance factory. This tranche is used to finance over a capex, or it might be used to finance interest payments during investment phase. So if there is no money in the model, in the financing model, during the investment phase to repay interest rates on tranches A and B, the project finance company might use tranche C. So the money as a syndicated loan goes to the project company, it's the SPV, in the end, special purpose vehicle company. And the company is enjoying a hedge from VEB based upon subsidy from the Ministry of Economic Development. A good thing about this mechanism is the fact that VEB is the interaction entity for the project. So the project entity doesn't have to go separately to the ministry and claim any subsidy, which might take some time. Whereas this is all realized by VEB. Here I'm coming to some statistics figures. You can see the timeline. The background is from December 2018 to November 23, few years. And as an example, if there was a loan in December 18, the cap level at that time was approximately 7%. You can see exactly it's 6.92%. There's a separate mechanism to calculate the cap level, which is fixed for the whole loan life. But on average, it's quite close to 7%. So if the cap level is at 7% and the interest rate on the market, the key rate of central bank is 8%, then this 8 minus 7, this extra 1% is compensated, is subsidized, and the project company is paying only 7% of the key rate, whereas the rest is coming from the subsidy, and the banks are getting 8%. Later on, you can see the rate went below 7. And for example, somewhere in the middle of 2020, in August, November, when the rate was significantly lower, there was no subsidy because the rate was lower. So the project company enjoyed a lower interest rate. Afterwards, you can see the rates increased. And for example, in February, March 2022, the rate went briefly up to 20%. And this was compensated through VEB. So basically, this is how it works. And this mechanism, once again, it creates stability for the project and allows commercial banks to be more brave while taking risks on long-term projects. Here on the next slide, you can see number of projects we've done so far. So the project formally was set up in 2018. The first project we signed in 2019, and since that moment, we've approved 32 projects, and 22 out of them are being financed at the moment. So the projects are under construction. In addition to that, at the moment, we have under consideration more than 35 projects. Here, I may say also that the total value of those projects is above $48 billion, whereas web participation is considered to be below 13. That's once again speaking towards our preference of commercial banks to join into the projects. The areas where we apply Project Finance Factory are here on the slide as well. Those are different types of infrastructure, road and transport, seaports, airports, but also we do projects in the petrochemical industry, in metallurgy, and other industries. Here is a slide about dynamics of syndicate market in Russia, but I would draw your attention to the last 3 columns where you can see the project finance deals are coming, and they're representing a part of the Russian market. I don't see figures here for 2022, but as far as I know, the figures are a bit lower, but bounced back in 2023 with more and more project finance deals coming now. Here is a real life example. It's a case of a road construction. For infrastructure projects, quite often we face the idea that even 20% of equity, that's on global perception of project finance, is quite low, but for high value infrastructure projects, it's still quite a lot of money. That's why we had difficulties with filling in with just equity from Russian and foreign investors. And Russian government, through regional budget, supported this project, providing equity as a capital grant. In addition to that, we structured with the banks tranche A and tranche B with commercial banks, and this syndicated loan enjoying this hedge mechanism from the project finance factory. So once again, this hedge is for all tranches, for A, B, and C, if it exists in the project. This specific project was recognized by, I can see here, national quality determining institutions, IRIS, and where we got level gold for that, and best PPP project infrastructure investment nomination. Here are a few words about impact and responsible investing for infrastructure sustainability. That's about this national quality determining institution. And thank you. Project Finance Factory is an instrument used to reduce interest rates during peak periods. And this in turn increases banks' interest to provide more longer-term financing. And having more running projects helps any country's economy to grow faster. Thank you. Thank you for listening. And I'm happy to answer your questions. I understand this will be at a later stage. Thank you.
Thank you very much, Andrei. Again, a very rich presentation, a very rich case study into the project finance factory. I think there is a lot to learn in terms of what you have done. I think at this point, maybe we allow the other panel members to come in and then we'll take questions afterwards. But for the delegates, if they are brewing questions as we are receiving presentations, please do type them on the chat, but you also get an opportunity to raise them a bit later. And at this point, maybe ask Mr. Amit Kumar Ghosh of Ministry of Road, Transport and Highways from India to just weigh into the PPPs. We've heard from Mr. Baldeo in terms of the journey of India in PPPs and the success factors in that PPP journey. And we've also now heard from Mr. Andrei Donskoy on the project financing introduction since 2019. And it looks like they've had some level of success in bringing project financing models, i.e. simplifying the access to long-term funding in infrastructure, and also finding a mechanism to deal with the volatility in the interest rate by providing a subsidy when it's required. So I'll hand over to you to just get your perspectives, and then we'll move on to Mr. Alexandra after you. Thank you very much. You are on mute.
Hi, everyone. Thank you for joining us today. When we discuss measures to increase the level of private investments in infrastructure projects, and colleagues from India, they tell us about theory and practice of PPP investments. Colleagues from Russia showed us a case study of Project Finance Factory. And today, I'd like to highlight the role of capital markets as one of the major sources of liquidity for infrastructure investments. And during this panel, I'd like to summarize key ideas and key challenges that investors face when they buy infrastructure bonds. Also, I'd like to highlight the solutions which we had implemented in Russian business practice and solutions which we think are quite effective. So hereinafter, when I say about investors, I understood that it's capital markets investors. So I mean, banks, investments, asset management, insurance companies who want to invest in bonds. So let's start. Let's discuss key challenges for investors who are able to buy infrastructure bonds. So the number one challenge is duration. The issue is that payback time frame of infrastructure projects is usually much longer than investment profile of capital market investors. The second issue is complex structure, because usually infrastructure bonds, they have underlying asset which generates cash flow, and this cash flow is transferred to investor. The third issue is credit risk issues. Usually it's quite difficult for investors to make a deep dive into the underlying asset and to understand project metrics and valuation of the projects, of underlying project. Fourth issue is liquidity. Every investor won't be able to sell infrastructure bonds in any point of the time, as he can make it with other types of bonds. And the last issue is market premiums, because due to complex structure and other issues which I have mentioned above, investors want additional premium versus plain vanilla instruments. So to sum up, investors are ready to buy infrastructure bonds, but only in case if all these issues have been solved. So now I'd like to tell you about how we in Russia, by Dom.RF, Housing Development Institution, how we solved these problems and how we attract investors to our products, to our infrastructure bonds. So first of all, as a development institution, Dom.RF, in housing sector, we endowed a special mandate from the government, and we finance infrastructure in housing sectors. So, I mean, such objects like schools, roads, hospitals, sports centers, and so on. Of course, we have special rules how we do it. So we finance long infrastructure projects from our own balance at preferential interest rates. These preferential rates are about twice lower than market levels. So we issue bonds by ourselves on market levels, and all these bonds are well fitted for investors in terms of coupon rates, tenors, credit ratings, all made perfect to boost the investor demands. We even do market making for our bonds and allow investors to buy it or to sell it at any point of the time. So as development institution and professional market participant, we take percentage risk, credit risk, and refinance risk on our own, and we separate it from the infrastructure projects. So government on its term, it helps us and its subsidies to cover the costs which we obtain to finance infrastructure projects. And this mechanism allows us to transmit funds from capital markets, and this is the idea, to transfer funds from capital markets to the housing sector. and the involvement of government is quite limited. As a result, for 2 years, when we started this mechanism, we already reached about $1.5 billion of investments from capital markets into housing infrastructure. And I think that it's only warm up for us, and we have a quite big horizons for this product. Thank you so much.
Thank you very much, Alexander. I think that was really insightful and tackling the infrastructure bonds and some of the successes that you've had. So I will allow Mr. Amit to come through at this point, and then we'll have a Q&A after all the panelists have weighed in. Thank you very much, Alexander. Mr. Amit, over to you.
Thank you, Ms. Mohaloli, and a very good evening to all colleagues here. I must thank this opportunity, and I must thank my colleague, Mr. Baldev Purushart, for explaining the PPP journey in infrastructure development for the country very succinctly as well as very thoroughly. I deal with road development. We build highways in India. My ministry's budget for the current financial year, that is from 1st April 23 to 31st March 23, is $37 billion. And with this, we do a variety of projects. As far as the PPP part of National Highways development is concerned, our journey in India began in early 2000s, and today we have come a long way from then. Our journey has matured, and we have very mature models, and I'll be very happy to share with this distinguished forum the opportunities that we offer to private investors to come in and invest for national highways development in the country as by joining our PPP projects. So, as I mentioned, in early 2000s, when we started with the PPP model for national highways in India, we took tentative steps, but one of the important outcomes has been, and it was touched upon by Baldev also, that now we have very robust documents, model documents, concession agreements, which are very mature and are internationally acclaimed and compatible. And we have many international companies, construction companies participating from all across the world in our tenders. All our tenders for national highways are global tenders. So at present, I have 147 ongoing BOT projects for national highways. I also have and I must mention that the value of these projects, must remember that they date from early 2000s and are still going on because of the concession period being 20 to 30 years for different projects. The value of these projects is about $20 billion. Now, when we started working on the PPP models, we faced a situation towards the end of the first decade of this century. And with the global downturn in economy, there was a change in mood and appetite for pure BOT projects. So the National Planning Commission, now called the Niti Aayog, it set up a working group under an eminent economist and advisor to the Office of the Prime Minister. And we have come up with a new model of PPP, which is also now under implementation. And it has proven to be very, very popular. And it is called the hybrid annuity mode. So the main difference between the BOT projects, 147 of them running, and the hybrid annuity mode projects is that in hybrid, the hybrid annuity mode, HAM mode, we provide 40% of the cost of the project to the successful bidder. The remaining 60%, the private player brings in. So it has provided a lot of comfort to the private investor. And presently, the HAM model is the dominant model for investment for private players for national highways development. So we have more than 100 HAM projects also under implementation, and I'm happy to share that we have about 25 projects which have been completed, and others are under implementation, and the concession period ranges from 15 to 20 years. What is important is that in both these models, we have allowed the concessionaire to sell the project to highway operators so that they can exit from after 2 years after construction is completed and commercial operation of the road has started. After 2 years, the road developer can exit from the project and sell it to another class of investors called highway operators. And the road developer can, with the liquidity so obtained, can go back to bid for other projects. So this is something which has led to a very healthy market in India of road developers and highway operators. Highway operators do not develop roads. They operate the roads, they collect the toll, and they maintain the highways. So I'm happy to tell you that from the PPP model, we have been able to further diversify. And in this, both on the road developer side and highway operator side, we have national as well as international players. So having said that, I would like to touch upon two things that Mr. Baldev Purusharth mentioned. Number one, that we have a huge target for infrastructure development of nearly $1.5 trillion called the National Infrastructure Pipeline, NIP. And in this, the predominant share is that of highways development as far as the central government is concerned. So for the NIP, when we are developing these highways, Mr. Purusharth explained that there is a national monetization plan also. So the highways we develop, we must monetize and we give it to private players to operate. So another PPP model for this is called the TOT model, Toll, Operate, Transfer model. Investors can buy our highways and give money upfront for the value of the toll revenue which they feel they will be, which they calculate rather, that they will be able to collect over the period of concession of 20 years. And that money which comes upfront is given to the ministry by the central government to further develop our highways for the next year. So as was explained that the national monetization plan is of 75 billion US dollars for India. And again, this Ministry of Road Transport and Highways in India is a major contributor to the assets, public assets being monetized in this fashion. Let me also mention that this ministry has set up a public sector infrastructure investment trust, INVIT, and the INVIT opportunity. INVIT is a world accepted structure for investments in operating infrastructure. And it became very popular with REITs, the real estate investment assets, investment trusts. So our regulations for INVITs are very robust and very transparent. And we welcome national as well as international investment by private parties in our INVITs. So the tax treatment is also very favorable for investors, especially foreign investors. We encourage that. So this structure for the InvIT is basically suitable for long-term patient capital such as pension funds, insurance companies, and sovereign wealth funds. We have successful investors in our InvIT projects, and I'm happy to say that uh, recently two very successful rounds of InvIT uh, InvIT investments have been achieved. So I can just tell you that in Indian rupee terms, we have raised more than 10,000 crore, which comes to about 1.22 billion US dollars in two rounds. And the third round is on its way. It is under preparation and we'll be launching it in this calendar year. So we have experimented with different models wherein private players can come in and invest. And we look forward to sharing our experience as well as providing opportunities to investors from partner countries in the BRICS ecosystem. We'll be very happy to provide any further information for investment opportunities. Thank you very much.
Thank you very much, Amit. Very complimentary insight and presentation to Mr. Baldeo earlier on. Thank you very much for that. I think at this point, let's get our last panelist, Dr. Marco Aurelio Barcelos of Brazil. And he is the president at Brazil Association of Highway Concession. If he can also give us his insights and perspective from Brazil side, we'll appreciate that. Dr. Marco, there you go. Welcome, thank you very much.
Thank you very much for this invitation, to the opportunity to participate with you. I was very flattered to listen to the experience from my colleagues from both Russia and India. And I do believe that in Brazil, it's not different. What we face, what we have been experiencing regarding PPPs and concessions. I think that the historical framework is pretty much the same. We used to have state-owned companies which were responsible for the majority of the investment in infrastructure. And at about in the 90s, I'm sorry, we started to have the privatization process beginning in Brazil. Those previous state-owned companies, they were transferred to private companies. We have testified afterwards an engagement or an enhancement on efficiency. And we then realized that not only through privatization, it would be interesting, it would be convenient to invite the private sector to implement infrastructure and public sectors. And although at the 90s, we had many privatizations, those privatizations process, they started to being followed by the concession of public services. And in the beginning of the 2000s, we started our PPP program. The inspiration that led the discussions in Brazil were also from Europe and also from the United Kingdom. And we studied a lot the British model and the Canadian model, also the South African model. And we do know what is the meaning of a project finance, what is the importance of regulatory agencies. And throughout the 2000 years, there were plenty of concession and PPP contracts. And what is important to understand is that nowadays, we have a huge pipeline of opportunities going on in Brazil. And we can both look at the future, and the future is very preeminent. I think that there are those huge opportunities, but we can also look at the past in Brazil and understand that there were lessons learned. And I think that the main message that the history of PPPs and concessions in Brazil, the main message that we can provide is that we have now a much more mature, a much more prepared regulatory framework, as well as a legal framework, as well as much more enhanced contractual model. And apart from many initiatives that we testified throughout the 2000s, as I said, the truth is that there is still an infrastructure gap in Brazil. People say that this gap encompasses something about $800 billion, and that we were supposed to invest 2% of our GDP, whilst we are only investing less than 0.5% of our GDP. So the investment in infrastructure in Brazil should really, or it really demands more money. And you know that it is impossible for the public sector to provide all the investments in infrastructure. So again, we are betting on concession and PPP models. And we are a federation in Brazil. And what we also have a characteristic which is specific from our country is that we have many PPP and concession programs. They are sponsored by the federal government, by the states government, and also by municipal governments. And the portfolio of projects that we both have and are about to implement in Brazil also encompasses many sectors. Probably transportation is the most known initiative that is held through concession and PPP in Brazil, but we also have hospitals, we also have schools, we also have what we call social infrastructure. And regarding the regulatory framework in Brazil, we have important national agencies which are responsible for the regulation of the contracts. We have the transportation, we have the airport, we have the portuary agency, and we can say that they have a very strong staff that can handle with all the complexity of our contracts. Unfortunately, the same scenario is not observed in the subnational level. So I think it is a challenge that we have to tackle so that all the concession and PPPs that are being prepared could take off in those states and in those municipalities. But in any event, we have just launched a new and humongous program of investment in infrastructure, which is called PAC, PAC, or the Acceleration Growth Acceleration Program. And it is sponsored by the federal government, but it provides for investment also at the subnational level. And it says that there is this expectation of investing more than $340 billion through the next years, which means that the portfolio of opportunities in Brazil is really, really big. And we will have concessions, pure concessions, which are those project finance models sustained through tariffs charged from users. But we will also have PPPs. And when we talk about PPPs in Brazil, we're talking about those concessions in which there might be tariffs, but also public participation. So the public sector provide funds directly to the investor. And the PAC, or this new growth acceleration program, encompasses not only concessions, but also PPPs in the Brazilian sense, and also directly public investment. And we have this expectation that Brazil in the next years will be this huge field of opportunities to investors from especially from abroad. And we do believe that the size of the investments that are expected, they impose a challenge for our country. The first challenge is granting that suppliers will be able to attend for this demand for investment. And we bet that we can attract foreigners to accomplish this demand. More, it is important to have new economic agents in Brazil as well to provide for the public service that will be considered. We have many operators here in Brazil, but we need more. And I think that another challenge that it is important to mention is the capability of our regulators and our public agencies to proceed all the authorizations and all the bureaucratic procedures that are needed for a PPP or a concession to be implemented. It is a problem, but it is a good problem, which means that we have maturity, we have an experience of implementing PPPs and concession of more than 3 decades, and we have finally achieved a political perspective, ubiquitous political perspective, that the gap of investment in infrastructure, which exists in our country, will only be addressed through private investments. And I think that the last message is that the amount of projects that are inserted in our portfolio, they are also very well discussed, and they are in a very mature stage to be launched to the market. So regarding our position in BRICS, I think that we have learned the lessons, and we, as well as India, South Africa, Russia, we are really attractors of investments. And I think that it is important for all of you to take care of it, to pay attention to it and to the investment opportunities in Brazil. Thank you very much for this opportunity.
Very much, Dr. Marco, very much appreciated. I think the theme throughout the lead speakers to the panelists, India, Russia, Brazil, it's very much the maturation of the partnership models over the years, taking into account, obviously, the nuances from the various countries and how that has enhanced and given success to the work that you have done over many years. And I think the numbers that you are calling, I mean, you're talking about billions and billions of dollars of work that has been done across these projects. It's quite impressive. And I believe that there is a lot to learn from each other. And sessions like this allow us to exchange the learnings and be able to contribute and grow from strength to strength. There is a question for Mr. Amit. I'm not sure if he's seen it in the chat. If you can have a look at the chat, and then while you are having a look at the question, I will take Budumelo, who would want to also ask a question. I assume, Budumelo, you're on mute. You can come through. We can't hear you. And you don't seem to be on mute. So maybe have a look and try and fix that. Let me get to Mr. Amit and see if he has been able to see the question. Amit, were you able to see the question?
Yes, and I'm typing the answer to the question.
Okay, you maybe you would like to share. Are you able to share in the platform? You are on mute.
My apologies. So the question from colleague Thabang Lisbon Racoena is that, I quote, hybrid model of a 40% deposit in PPPs is interesting. I've heard of the same model being proposed in some country in Southern Africa, where the remaining 60% would be financed from regular government budgeting. The Canadians call in a FIDIC model. However, my key question is, doesn't it lead to crowding out of government spending? Can you finance a lot of projects given the limited fiscals? So my reply is as follows, that unlike the example quoted in the question, in India, the government funds 40% of the project. 60% is brought in by the private concessionaire. The concessionaire typically brings 20% as equity and 40% as loan from lending institutions such as banks or infrastructure financing corporations. So this is the model, 40 from the government, or in the document as we say it, the authority, 20% as equity of the private concessionaire, the company which wins the bid, and 40% from the lending institutions. So this actually does not really crowd out the investment, because the number of projects is so high that I'm actually able to do 2.5 times more. So with 100 rupees, if I were to do one project, here I can do projects worth 250 rupees. So this is the advantage, that with limited government money, I can do more projects, given the support available in India from lending institutions. So this is the advantage of hybrid annuity model projects in the country.
Thank you, Amit, for the response. Much appreciated. Widumelo, would you like to try again? Widumelo? Okay. No, let's see if there are any other hands, questions. Okay. I don't see any hands in the delegates. Maybe again, come back to the lead speakers and the panelists if they would like to come in on the parting shot. If there's another point that came to mind while others were talking that you would want to speak to, I'm giving you an opportunity to do that now. Okay, looks like we've had really very comprehensive presentations, and would you like to come in, Amit?
Insofar as India is concerned, I would like to assure partner countries in the BRICS ecosystem that we will be very happy to assist companies which meet the legal requirements and the contractual framework of our country. As I mentioned, it is a very robust PPP model that we have in our country. Thank you so much.
Thank you very much. Let me thank you and the lead speakers and the panelists for their insights into the partnership models. I think the richness of the presentation and the case studies that have been presented. There is certainly a lot to learn and a lot to collaborate. And as I've been repeating throughout the session today, that this is just the tip of the iceberg. I think a lot of the collaboration and the conversations will take place outside of this platform, and those conversations are being encouraged so that we are able to learn from each other. We're able to, advance the work in the infrastructure financing and infrastructure development. We are at 4:27, and I just want to maybe go through some of the key takeaways for today, in case if we missed anything, just from my side as the facilitator, what I think were overriding themes that were coming through. And after I've done that, we will then move to close. I would not be taking a lot of your time. I have committed to wrap up at 16:30, so if you can just bear with me. And from session 1, which looked at the infrastructure development landscape, some of the key takeaways from that session is that there is certainly an appetite for intensive capital investment towards renewables, digitization, transportation, energy, social infrastructure. And we've seen from Henry's presentation that the cost of construction is increasing, which then in real terms, we're seeing as a result less investment in infrastructure. So that's one area that needs to be looked at, and the cost is even in some instances greater than the rate of inflation. So it is important that macroeconomic space, while we're talking about the nitty-gritties of infrastructure, it's also important to consider the macroeconomic space, the monetary policy, and how we think about inflation, so that we are able to continue to provide this construction of infrastructure at rates that are sustainable. And the second point is around the role of pension funds and in bridging the investment gap, as illustrated by Dr. Mamiko earlier. There are obviously factors that needs to be taken into consideration when these pension funds invest in specific, and some of these issues include the risk profiles, the government policy, the scale, complexities, amongst others that needs to be taken into consideration to create an enabling environment for pension funds to continue to direct those funds in those projects. Throughout as well, we also got reminded in session 1 that infrastructure is a long-term game, and it requires planning. It requires long-term investments that ensures sustainable infrastructure investment. And there's been lessons and case studies that we can point to in so far as how do we scale infrastructure, and how do we fast track. I mean, other countries, India, China, you've had, in a very short period of time, done massive infrastructure development. And I believe there are lessons in that regard, and the various models that you've utilized to be able to fast track the infrastructure investment. And one critical point is that government, public sector cannot do it on its own, i.e. the public funds, the fiscus is constrained in most cases. Government debts are very much unsustainable, and therefore crowding in private sector participation is quite important. And key to that is creating an enabling environment that would ensure that private sector is able to participate in infrastructure development in the various countries, and further the sustainable development theme. And that was mostly around session 1. And session 2, we changed gears a little bit, and we started looking at the various partnership models that are supposed to then support infrastructure investment. And some of the key highlights is that there's importance of private capital that will provide a capital contribution for addressing the infrastructure funding gap. And in the case of both India and Russia, we noted the use of project finance, the public-private partnerships as well in crowding in private sector investment. We also note the valuable contribution made by the government in these respective countries in terms of de-risking public infrastructure investment, risk and more risk when we talk to private sector participation, especially in infrastructure development, is a key consideration in how you create these opportunities, i.e. through an enabling environment, but also look at the risk profile and how you manage the risk to crowd in private sector participation. I think it's also very important. And we've seen countries throughout this session that, have also explored, various models of blended finance where the government would contribute a sufficient capital to de-risk the project and also crowd in the private sector involvement. The work that has been done and the successes that have been achieved are not without challenges, and the panelists and the lead speakers have been very kind to share with us some of the challenges that have been experienced, ranging from limitations with the buying and selling of infrastructure bonds in capital markets, the suitability of, for example, infrastructure bonds for patient capital that may not be ideal for capital markets or even banks, given the long-term nature of infrastructure, and also the limited understanding and access to underlying asset by capital market. Some of these structures can be quite complex, so it is very important that these challenges are understood in that context. But I also liked appreciating the theory, but also appreciating the fact that the practice that you bring in is able to bring in a much more balanced approach of theory and practice in terms of learning by doing and improving the process. India has moved from their initial PPPs, and they're talking about a hybrid model that they're utilizing as well. So there is learning as we are doing, and I think that is greatly appreciated as well. And there are some solutions that were given looking at ease of buying these, the infrastructure bonds, Russia looking at subsidies by government to reduce the investment cost associated with blended financing. And all these, I think, depending on which side you're coming from, I think there is a lot for everybody to take and to try and see whether they can improve their own areas. And we also welcome the invitation by the BRICS member countries to be able to learn from each other. And I believe that the learnings will be coming, the presentation will be shared, and many, many more questions will be coming through for all of us to engage in. And I hope that as we reach out to each other privately, we will receive the same kind of enthusiasm that we have seen on this platform, and we can continue to co-create together. We can continue to build and be able to develop and close the infrastructure gap that we are seeing. We've seen that not a lot of money from pension funds is flowing into Asia, into Latin America, into Africa, into Middle East, and therefore there is need to also use our own resources. There was also a very valid point that the local capital markets, the local pension funds have a big role to play in development of infrastructure. And I hope that that message will also come through so that we can do it in our own spaces respectively, so that when we start crowding in international, regional financing, that we've already created a space where we are already doing work for ourselves. So I would like to thank you very much for being good sport. Since 12 o'clock, you have been helping me facilitate this session and try to get various important messages and themes across that we can learn from, that we can resonate with. And I hope that the session tomorrow will receive the very same treatment as we look at other aspects of digital infrastructure, looking at sustainable instruments, whether it's green transition, sustainable projects, and also looking at the role of multilateral development institution. Infrastructure in the main, it's about development, and MDBs have played a significant role in advancing development of infrastructure. And I hope that you'll come back again tomorrow and we'll be able to continue this dialogue and exchange ideas and share learnings and take it to our respective spaces of influence and of work, and make the most of it. So it is 4:37, and I would like to thank you very much and stop here, and wish you good evening, good afternoon. I'm not sure who is in morning yet, but thank you very much. Thank you very much.
Thank you so much. Bye.
Thank you, Baldeo. Much appreciated. Alexander, thank you. Marco, thank you very much. Thank you very much.
Thank you very much. Bye-bye.
Thank you.